Right, a very warm welcome to everybody here in Cape Town today. And it's very interesting to run the first hybrid BCI conference since COVID broke 2 years ago. It's almost to the day, exactly 2 years ago that we were here, and then things escalated with COVID. So very interesting to speak to some live audience members, but heartily welcome to all our virtual audience members out there. Pity we can't see your faces. It would be nice to see you again soon, but thank you very much for joining. Like I said, this is the first hybrid BCI conference. We will run live as well as virtual. So for our audience members here, you're welcome to pose any questions to the speakers. And for our virtual audience, it's business as usual. You've got a Q&A room, so you're welcome to pose questions there. We'll keep our eye on the Q&As that's coming through there. And after each presenter or after each topic, after the two presenters, we've allowed for about 5 minutes for a question and answer session, and we'll try to deal with as much questions as we can. And yeah, very interesting when you do live sessions as well. So I actually had to wear pants today. It feels a bit strange. Right, maybe just if we look at what happened over the past 2 years, since we last met here, or since we had live venues, we know all about COVID. Second half of 2020, we saw some really, really good recovery. 2021, exceptional year. Any kind of numbers you looked at was just absolutely spectacular. And then we had January, right? We all knew that 2022 is going to be a little bit more volatile with talks about global inflation, global interest rates. I think some of those topics are still boring, but it's very real, it's very relevant. We are going to touch on some of those issues today, but we never expected, 2022 to really start off that hectic. The last 2 weeks has been good in the market, so things are recovering and settling down. But from our side, we would talk to clients or the investors out there. We normally tell them, expect a bumpy ride, but you're probably going to end up well at the end of the year. So let's see. Just maybe a funny pun that I received from one of our partners, one of our virtual audience members here today as well. It's where your dad sends his daughter a WhatsApp message and says, what do you want for your password? And she replies, she says, chicken. And he replies and says, yeah, it needs a capital. So she replies and says, yeah, chicken Kiev. Well, there you have it. Ukraine, Russia, we all know, also causing a lot of volatility. Where is that going to come out? I don't know. We'll talk about that and maybe some of the questions you want to ask today. We've got a fantastic lineup of some of the top quality boutique managers in SA and globally for you today, covering anything from global equity to SA fixed income and everything in between. So I think there's a lot of room or a lot of discussion points that will help you in addressing some of the issues with your clients. Maybe just a quick reminder for the audience members here, there's QR codes at the back. Make sure you scan that code, register for CPD. I think most of you have done that already. Our online audience, you've already registered if you dialed in, so you'll get your CPD and we'll confirm the CPD points as soon as possible. Our first topic for this morning or for today is global equity and global property. And on stage with me, I'll welcome Richard and Gareth. Richard from Blue Alpha and Gareth from Reitway, and both recently also got Raging Bull Awards, among several you've received already. And it's funny enough, some clients make a joke and say, but if a manager received a Raging Bull Award, he's the top of his game, so maybe look somewhere else. But I think in an instance with Blue Alpha and Reitway, it's very, very different because it's an absolute high level of consistency, continuously. And I know with restaurants you get like a Michelin award. Maybe they must do a Michelin award for fund managers, absolute consistency over time. So gentlemen, welcome. Thank you for joining us here live today. And we look forward to your presentations. The agenda for the day, just very quickly, like I said, there's a couple of topics. We start with global equity and global property, but I'm going to hand over to Richard. Richard, thank you very much. The stage is yours. Thanks.
All right, thanks, Eugene. Good morning, everyone. Eugene, you brought us here on false pretenses. Gareth and myself, you told us this was going to be a packed audience. But obviously, the COVID habits of staying at home don't die easily. Okay, so I thought I was going to do something slightly different. You know, we're so used to doing these online presentations, and as Gareth can attest, and as you all know, you stare into a screen and you get very little feedback from the audience. But I want to talk about a market narrative, and before I do that, I just want to kind of play a little game with the audience that's here. And if you could just go with your gut, please. So the scenario is you have one die, you have 100 throws. If you hit your number in the 100 throws, you 10 times your money. If you miss your number, you lose all your money. And the question is, do you change your guess every throw, or do you stick with one number? If you could just show me a show of hands. Just gut. Does no one got an opinion? What do you do? You change your number. Anyone else? Change. Why do you change it? Okay, you're obviously a clever bunch of people. If you ask most people this, they will say they will stick with a number. And of course, what some of you figured out, who answered, is that the probabilities are actually totally independent. But it's very easy to kind of make a mistake like this. And I want to take this idea into the kind of market narrative that I think is going on at the moment, which, you know, there's a very simple story about what's going on in the stock market. And the story starts with interest rates. And this is a fabulous chart going back to 3000 BC, if you can believe that. Now, where Bank of America got a chart of interest rates going back to 3000 BC is anyone's guess, but there it is, short-term rates, long-term rates. And so that's interest rates over 5,000 years, which kind of makes me think about global warming when people talk about temperatures that were measured 500 years ago. I always wonder where they get these numbers from. So we know this is like the kind of big fear factor, the starting factor. We've got very, very low rates. Very recently, we're starting to print high inflation, 7% inflation in the US. And you know, we know what's driving that. Some of it is supply chain issues through COVID, and there's been a huge amount of money supply, whether it be the Fed increasing its balance sheet or just M2 itself, something like 11 or 12 trillion dollars over the last 2 years. And now the Fed needs to start thinking about fighting inflation, raising rates. So we know rates are going to raise. The question is how much. And the market narrative that develops from that is, if rates go up, this is bad for growth stocks, and this is good for value. And this is a very, very simple way of looking at kind of the stock market fundamentals. So I want to sort of unpack this idea a little bit further. So does the maths make sense? Well, certainly if you think about a growth company with cash flows a long way in the future, and you just have a very simple discount model, clearly those cash flows many years out will be worth less as you increase rates. So that's true. And if we look at the data, it sort of seems to confirm it. Here we just show the NASDAQ, the level of the NASDAQ over the last 20 odd years versus the TIPS yield, which is, let's call that a proxy for real rates. And we can see basically as the data point for lower rates is, as we have a data point for lower rates, the level of the NASDAQ, which we can call a kind of proxy for growth, goes up. And that's the regression line through it. So it kind of seems to make sense. If you look at it visually, over a slightly longer time, 30 years, we've got the Fed funds, the Fed rate in dark blue, and in light blue, just very simple Russell value versus Russell growth. And I mean, there's a very loose relationship here visually. You can, clearly you can see times where rates go up and value beats growth, but equally you can find times where rates go up and growth beats value. So it's kind of sort of seems like there's some kind of relationship, but not highly compelling. And in fact, if you crunch the numbers and say, what is the correlation? The monthly correlation, I think, is about 0.01, and the annual correlation over a 4-month period is something like 0.09. So, I mean, to all intents and purposes, the correlation is not really relevant. So we unpack the data a little bit further, and we look at the percentage change in real rates versus the daily percentage change in the NASDAQ. And this is the scatter graph that you get, very concentrated. I'm told that the result is statistically significant, but it's minute. And basically what you can conclude from this is if rates go up, the NASDAQ tends to drop by a very, very small amount. But it's almost insignificant. So I think when we think about value, growth, and interest rates, one of the major problems is that we've been through a structural decline in interest rates. So I think be very careful about this narrative. So what's really going on? So this is a graph you're all familiar with. This is non-profitable tech, gets thrown around all the time. And I think what's interesting about this kind of index is that actually non-profitable tech started selling off a year ago. So it was way ahead of this supposed shift between value and growth. A proxy for non-profitable tech, of course, is Cathie Wood or ARK. And it looks to me like, maybe I'm being a bit unkind, but if you buy ARK, you're buying non-profitable tech with some trading costs and some management fees. And then as a proxy for value, but not deep value, and not value as in cheap, but value also in with the merits of capital allocation. We've taken, we're just showing Berkshire Hathaway here. And you can see this thing has kind of made a full cycle back to where it was. So, deep value is kind of almost regardless of the kind of business metrics of the company. I think Berkshire thinks quite deeply about capital allocation, and so it's a different angle on value. And then finally, if we think about technology, if we take the highest quartile of the stocks that we used for this analysis, this is big tech, the companies with the highest return on invested capital. Yes, they have come down in the last couple of months, but nothing like non-profitable tech. So there's something else sort of going on. And if you look at it at a sort of sectoral level, and I hear this year in particular, a lot of value managers saying this is the moment. There's no doubt this is the moment. And in fact, they'll show you the value versus growth chart, and it's been doing a bit of a W. I think that's technical analysis. They will also show it that it's at a very similar level to where it turned in 2000. It actually doesn't mean anything. That's just a chart. Investments is actually about economics. But if you look what's going under the hood of this trade, what's outperforming? Consumer staples, energy, obviously. We know energy prices around the world are very high. Oil's very high. Financials are benefiting from an apparent steepening of the yield curve. And I guess one of the losers has been technology in a broad sense. It's interesting that consumer discretionary hasn't done that well either when you consider that the US consumer cash balances are something like $1.8 trillion, cash and cash equivalents, so as high as they've ever been. Now, this is certainly up until recently, this was the best performing stock in the S&P 500 year to date. And let's call this, well, let's not call it anything just yet. And this goes back to 92, so quite a long time period. We're showing the profile of debt, the net debt on the balance sheet, and you can see it's a nice, steady upward curve, which is obviously not a good thing. This is the return on common equity through time. And just to highlight it, the red line is the zero line. So you can see this company, a lot of the time, loses lots of money, very cyclical company, and then makes quite a bit of money. And the company is Halliburton, provides oil and gas, services to the oil and gas industry. So this is not the kind of company we would buy, but certainly if you've had it this year, you've done very well. You could argue this is a value company. We would say it's a very, very mediocre company that's highly cyclical. So when we think about cheap and value, a lot of value we would argue is masquerading as low quality. And here we've done a little model, and we've taken the weighted average cost of capital at 5.5%, which is what the Stern School of Economics tells us that it is at the moment. And we've created this hypothetical model, and we say, what happens? Well, the first point is, what is the true economic profit of these different businesses? And the maths is very simple. You take the return on invested capital, you deduct the cost of capital, and you multiply that against the company's investing assets, the assets that it's generating its income from. And you get these numbers. And then what we do is we just increase the cost of capital by 1%. And you can do this model, you can verify it at home if you like. We've kind of one of the issues is, do you use the same capital base or do you use the same accounting earnings? We've got a blended model here, but the outcome is exactly the same. And what it shows you, and it makes perfect sense, is as rates go up, as the cost of capital goes up, the company with the highest buffer, which is company A, the highest return on invested capital, obviously loses less. Its earnings, its economic profit, its real earnings decline by about 11% over these different points, going from 5.5 to 7.5. Company B declines about 44%, and company C, low return business, very quickly creates negative economic profit. So I think that's an important thing to think about. The other thing is, because we think quality has been caught up in this value growth rotation, and we are unashamedly and committedly sort of quality investors, and by quality we mean investing in companies that generate high returns on invested capital. So rates are going up, and you could say rates are going up because the economy is on fire, and certainly there's a lot of recovery in the economy. But if you look at global earnings revisions, there is potential that that's rolling over and that the environment is actually becoming a bit more difficult. So obviously the whole economic cycle has been distorted dramatically because of COVID. So it's not the normal playbook. And if that is in fact the case, and we're going to a sort of tougher profit cycle, then history shows that quality is the place to be. And so when you look at our fund and how we're positioned, and here we're going to show across a couple of factors, quality, growth, momentum, and then valuation, what does our portfolio look like on a ranking basis versus the top 1,000 stocks by market cap? That's kind of like our peer universe. And you can see we are very highly skewed or overweight quality. We also have growth in the portfolio because quality companies that can grow generate a huge amount of value over time. We have some momentum. This is earnings momentum and price momentum, but kind of moderately above the market. And then our chosen valuation metric, which would be enterprise value to free cash flow, slightly overweight, but almost at the market, and valuation on a PE basis, we're at the market. So this then, to kind of summarize our main ideas, we think the narrative is the idea that clearly we have rising inflation. There's a whole host of reasons for that. The Fed and central bankers globally have become more hawkish, so rates will increase. This is bad for long duration assets. Growth stocks falling, value stocks rising. This big rotation that everyone's been waiting for, or the value guys have been waiting for, is now happening, and this rotation is also impacting quality. I've spoken about energy and banks. Oil is up 4 times from its lows. You can be the judge of, most commodity markets are in backwardation. Oil certainly is, so that means that there's an absolute shortage in the spot market, and expectations are that prices will fall going forward. And then banks obviously relying on a steepening yield curve. So our view is that there clearly will be an increasing rate cycle. We need some normalization, but also that the rates will remain very low. And we have to accept rates can go up a fair amount and still be incredibly low. and that is very supportive of valuations. Inflation is undeniable, but supply constraints are part of it, and I think just simple base effects. I mean, one of the big surprise factors over the next year could be inflation, the printed numbers coming out much lower than what people think. As supply chains ease up, and as the base effect, the impact of a higher base effect causes a rollover in the number. So in terms of positioning, we don't specifically position our portfolio for the macro cycle, but we do think about how the macro cycle would impact our portfolio, and we think if there are rising rates and inflationary pressures, you need companies that have pricing power that can pass on the impact of inflation. Also, those companies that have strong operating margins, as we pointed to earlier, with that kind of theoretical model. And then clearly, robust balance sheets helps a lot. Companies that are borrowing a lot will clearly be more at risk as rates increase. So the type of companies that we have in the portfolio, we spread between what we call quality growth, stable quality, and cheap quality. Quality growth being companies like Accenture and ServiceNow. Stable quality, Microsoft, Apple, and NVR, which is a home builder in the US. And then cheap quality, Lockheed Martin, AutoZone, Intel, the dreaded Pfizer, and AbbVie. All very cheap companies that have, in some cases, very good returns, in other cases, reasonable returns. So just a quick, how much time do I have, Eugene? 5 minutes. One of the companies we've owned for a long time, AutoZone, quick summary of it, it's a kind of best-of-breed auto parts retailer in the US, and is expanding globally. It has a growth expansion plan through Latin America. It's a company that's highly focused on efficiencies and returns on its invested capital, with a 30% plus return on invested capital. Very strong cash generator, currently on a 7% free cash flow to EV yield, and has a $3 billion buyback. Now, this just shows you the free cash flow over time with some forecasts going forward and the share buybacks. So clearly this company is a cash machine, and it uses the cash to buy back its shares. It's spent, the market cap at the moment is about $40 billion, and it has bought about $30 billion of shares since its listing. And if you look up the share itself, it's been a wonderful performer, not because it's a huge grower, but because it has very high return metrics, and they keep using that cash generation to reduce the share count and make the equity component smaller and smaller. Of course, you could say, well, what about the whole EV theme, electric vehicles? How will that impact a company like AutoZone? I think in the long run, it certainly will have some impact, but I think that's going to take a long time to play out. And what's happening at the moment is that the car pool is aging, because there's also been supply chain. I mean, anyone who's tried to buy a new car in South Africa would know, it's very hard to get new cars because of supply chain. So at the moment, they have the wind at their sails, in their sails. And then Pfizer, stock that we've had for a while, interesting company. I mean, Pfizer, prior to COVID, was, what was Pfizer? It was really it was a declining pharmaceutical company. Products off patent. It just had no growth metrics. So I think COVID has been kind of like a transformational event for Pfizer. Whatever your views are on COVID, we don't go there anymore. But I think there's a lot of contracted supply. The company has, there was an earnings announcement yesterday. They confirmed this. So there is going to be a huge bumper earnings cycle for the company. And in terms of how we handle COVID, I'm amazed even now that we come in here and fill in these forms and they take our temperatures. But regardless of that, I think it's going to take a long time for us to dial back this approach. And I think that will be good for Pfizer. New treatments, they now have the COVID pill, Paxlovid. They have the technology partnership with BioNTech, which could lead to other potential blockbuster applications. And in terms of cash, expectations are that the company should have something like 80 billion net cash on the balance sheet in a few years' time. The current enterprise value is about 300 billion, just to put into perspective. And then if we look at the company, what's been happening, this is the earnings per share relative, so the forecast earnings through time versus the S&P. And you can see kind of was going sideways, and now it's had this huge uptick. And this lighter blue line is the price relative. So the company was at a 30% discount to the market for good reason. It was very unclear where the next sort of, what the growth trajectory was for Pfizer. There's been a big kind of transformational event, as we say, and now the company's at a 60% discount to the market. So there are these kind of opportunities where you don't have to worry too much about the state of the market or value or growth or how these themes will play out. So this is our performance. We launched this fund in September 2014, and the long-term performance has been good. I guess over the last year, we certainly have been caught a little bit by this rotation. Not caught, but impacted by it. So we vaccinated, but we're not immune. We also will be impacted by these changes. But I would say one-year performance is almost a lottery, and you really need to think carefully about longer-term performance, and how does the manager deliver their strategy, and does the strategy make sense? And based on our performance versus the benchmark and against our peers, and some of the awards that we've got, I think there's more than enough evidence to show that our approach does work and that we deliver it in a consistent way. This is my last slide. So going back to the idea of consensus, narrative, interest rates up. The consensus now is we're going to have very high inflation, and value will beat growth. I hear that a lot. I think there's a chance, as I said earlier, that inflation could moderate, could be a lot lower than we think. I think rates in the end will go up a lot less than what people are talking about now. It's very alarming and exciting when banks bring out these forecasts of 5 to 7 interest rate hikes. But I think we will have the surprise will be if we have a much more moderate environment. And then, of course, imagine if this value growth, the simple value growth trade doesn't play out as expected. So here I'm just showing flow versus returns going back 12 years, back to 2008. And I'll just point out the extremes. So the red line is flows into global bonds, and that over the time period is about $3.5 trillion. And the flows out of US equities is the bottom line, dark blue line. And then we look at the subsequent returns, and the worst performing asset class was global bonds on the very right in red, and the best performing asset class was US equities. So all I'm saying is be careful of the consensus, particularly when the consensus is very simple, very straightforward, and maybe just based on kind of heuristic shortcuts. The other final comment I want to say about US equities, which people kind of like to bash, is that most of the large companies in the US are global companies. So, you don't necessarily have to get caught up in this whole debate about investing in a US listed company or a emerging markets listed company. What you do need to think carefully about is what are the operating metrics of the business? What is the return on capital? What is the growth potential? How broadly spread is the company globally? So thanks very much. I will leave it there.
Thanks very much. And it's a pleasure again to be speaking to a room full of physical people. It's been a long time. So some observations for those of you who are still virtual is some things change, but some things don't. So people don't like to sit in the front of rooms still. I can give you that feedback. And the other feedback is if you're a tie retailer, you are going to go out of business because there are a whole 3 of us in the room wearing ties. So I feel very overdressed at the moment. So there's the feedback to those of you in the virtual world from the physical world. And thank you for joining us today. Our team has been working hard. It's been stressful the last 2 years, but we've done well. We're a citywide AA-rated team, and that's on a global basis as well. So whenever we talk about, we're a global property manager, and we rank ourselves versus global peers, not just South Africa. So whenever you see that, these are global rankings, and we are really proud of those. Our products, we are located in 3 locations. We have products in Australia, through Malta, and in South Africa. Our flagship is the REITway BCI Global Property Feeder Fund, been performing very well over the last 2 years, and we're very proud of that performance. As Eugene mentioned, we just won our 4th raging bull, actually, this month. So we won last year within the local base, and this year we won within local as well as the offshore base as well, which we're very proud of. Morningstar 5-star rated internationally as well as South Africa. And then also in our Australian funds, we were also up for Fund Manager of the Year in Australia within the Global Property last year, which we're pretty proud to get a nomination there. Unlike our awards here, they have lots of subjective measures when it comes to choosing who wins that. So as a South African, I think you probably a little bit of a disadvantage versus Australians in that, but nevertheless, we're still proud of ourselves versus that. Looking at our geographic allocation over the past 2 years, this has changed quite dramatically. Property certainly hasn't stood still during the crisis, and there's been some very stressful times, March 2020 and limit down trading days, where that's where the last bit of my hair went, and that's also why we no longer have the beard, just because there was just so much grey from that. But we've seen a very nice recovery from March 2020. Last year was a very good year. This year has been a little bit more stressful, and we'll get into that in a bit more detail. But we've changed our geographic allocation. US actually, for a change, has started to come down a little bit. Most of you who know global REITs will know that the US really is the juggernaut of the global REIT market. It takes up the vast bulk of index allocations. So we've typically been here literally at times close to 70, and now we're down at about 60, moving more of our allocations more towards Europe. We had a very strong run in the US last year, but seeing Europe start to fix up the gap between itself and the US as this year starts to roll forward. We then also have just under 5% in the UK, so obviously now with them splitting from Europe, we'll make sure that we keep that out so that they can live in Brexit land. Still one of the most bizarre decisions ever made, but that's the UK for you. Japan, we've slightly started to take our allocations up in Japan compared to 2020. During most of 2020 and early parts of 2021, we cut Japan down to almost zero. They were hit very hard by COVID, starting to recover a bit also in Japan. The sector allocations, most of their property companies are giant diversified companies, very stable, but not a lot of growth. So at times it's a useful component within a portfolio, but if you're looking for great performance, at times Japan can really be a drag on performance. Canada, we've also started to go back into over the last year. I've seen some very good performance there, especially on the residential side. So residential has been a great sector over the past year and a half. I think it's something we forget here living in South Africa, seeing property prices do nothing, whereas if you've been in Canada, the US, Australia, and the UK, over the last 2 years, you've probably seen your house go up between 30 to 40%, which would be lovely if we could have it here, but sadly, I don't think it's going to happen anytime soon. China is another market that we started to go back into. Our Chinese investments, typically we will always do those through NASDAQ listings in the US or through the Hong Kong market. We don't invest in direct holdings on the Chinese markets themselves. And then Hong Kong, also a very small allocation there. And then within our, we have about 6% cash at the end of last month, keeping that as an opportunistic basis. We've seen a lot of declines, so we've seen some nice good value opportunities coming up in the last month, so that's been very useful to have that cash to deploy. We have a very strong focus on sector allocation. So we believe, and our research shows, that getting your sectors right in terms of property is probably one of the most important parts of the asset allocation process. So for us, we are index agnostic. It saved us from a lot of bad performance, especially when during the COVID periods, and we really do look for those sectors that are showing the most resilience, the most growth at that particular stage within the cycle. You'll see most of our exposure at the moment is through the residential sector, and that will be through the US, through Germany, through Australia at times, through Canada, and Europe. Then industrial has been one of our main overweights for probably the last 4 years now, which has actually performed very well and continues to perform very well. We have a strong focus. The big difference you'll see there that's new, especially for us over the last few years, has been the moving up of retail. If you go back 2 years, our exposure to retail would have been about 3% in February 2020. In March 2020, it was zero. Actually, at the end of February 2020, it was zero. So we had exited all those positions prior to COVID hitting, which saved us from most of the damage that was caused by the COVID crash. Office, we are starting to slowly move back into. It's still one of the sectors that's under a lot of pressure and a lot of noise. It really depends on the market you're in and the office subsector as well. So most of our exposure here on the office side is actually more through the life sciences parts of offices. So these are the companies that are developing the new vaccines, the new medications, etc., the Pfizer, the BioNTechs of the world, not your basic office players that are out there. Specialized, these are data centers, cell phone towers, fiber optic networks, always a sector that we've had a lot of experience in over the past few years, has worked very well for us. For example, 2 years ago, that would have gone north of 10% our exposure on the specialized sector there as people moved more to working from home, and we've obviously changed that as this whole process has worked through. And then healthcare has been one of the sectors that's been under a lot of pressure again over the last 2 years, unsurprisingly. Starting to recover a bit, but it's still moving relatively slowly. Storage, a fabulous sector. South Africans have a little bit of experience now with one of the locally listed companies that's operating here. But in terms of the US and the UK especially, self-storage had a fabulous year last year, and I'll delve into that in a little bit. And then diversified, you'll see, is one of the sectors we always have the lowest exposure to. We don't like diversified companies. We like sector specialists who focus on doing one thing and doing it really well. Our top 10, you'll see our sector preference coming through there quite a lot. And it's primarily, again, on the industrial side. And there you'll see we'll take positions in what will be global champions, such as Prologis, and then regional champions, such as VGP, which is one of the best European industrial companies that's performed exceptionally for us over the last 3 years. And then now you'll see that some of the different ones coming through, like Simon, for example. It's been out of our portfolio for quite a while, but we added it back in last year. Performance extremely strong on the mall side, and that assisted us quite a lot last year. And then a good geographic distribution there as well, including Canada, Sweden, etc. So we go where the returns are that we're seeing, and we hope that those come through for our investors. We're very happy that we've now moved into our 10th year. So when the inception number there, that's our first 10-year number, which we are very happy to have and to present to our investors. We have stayed ahead of the index since inception. We're very proud of that. We're also proud of the fact that we've done that with less volatility as well. Last year, we had a very good year in terms of returns, but for us, we were very unhappy that we didn't manage to beat the benchmark on a one-year basis. As was mentioned, a 1 year at times can be a little bit of a lottery, especially when you have things moving very rapidly the way they were. But our focus really is making sure that we never actually lag. But on 3 years plus, we remain ahead of the benchmark, and quite substantially so, especially on our 3 year and 5 year basis. Now, the COVID saga, I think we've all been living through it for a long time, and I think it's become very tedious, and there is still a lot of, I think, security theatre around, but it's still continuing. And what we identified several of the phases within it and how we've performed on it. This is our performance in orange versus our peer group locally, as well as the benchmark, and we now basically within the inflation strikes back phase of this whole continuing saga. We're very proud of our performance versus the index since the start of COVID. So this would be on a rolling 2-year base. On the bottom there, you'll see we've managed to beat the index by just under 20% over a rolling 2-year basis. And that really goes to active management. So active management really matters when the markets are going through extreme phases. The plus with a passive product at times is that when everything's going up, you get everything. The problem with a passive product is when everything's going down, you get everything going down. So when you have an active manager, you can avoid this. You can also move out of the sectors that are changing rapidly. You know, indexes didn't make the changes to go into data centers, cell towers, different telecommunications things at the start of 2020, whereas an active manager, we positioned ourselves to say people are not going to be going to the malls. They're going to be staying at home. They're going to be doing online shopping. How do we change that? How do we structure our portfolio? And we think it's come through there and performed very well. At times, as I said, you'll get caught out where you can have passive companies getting that bounce. So, for example, in the vaccine bounce, when that came through on one morning when that Pfizer trial was announced, is every passive company gets all of that bounce. So we then have to recover from that, and we did, and we continue to focus on it. So looking at last year, very much a tale of two halves, and I have a feeling this year is probably going to be very similar. So at the start of last year, you had retail starting to come through very strongly. The same with office to a certain degree too. You'll remember the AMC meme stock bizarreness, well, which is actually still going on to a certain degree today. You had one of their landlords, which was Macerich, being caught up in this thing. You had a stock literally doubling in the space of almost a week. Bizarre times. But as the quarter and the half rolled on, is the market returned to a more sustained and logical way of looking at the sectors, and you started to have storage coming back. Industrial starting to recover very strongly, and residential especially, and you started to see, you know, office sort of getting that bit, but then it's under so much pressure and noise that it just can't really find a sustainable level as we go forward. The second half, you saw that very strong performance carrying on, especially for storage, especially on the industrial side. If you think of all the supply bottlenecks, industrial property is still under massive demand and need. It's becoming more and more difficult to actually find permitted positions to build new warehouses. People, unsurprisingly, are really getting into the NIMBY mode where they do not want a giant warehouse anywhere close to where they live, but they still want to be doing their Amazon shopping. So if you have permitted premises, it becomes more and more valuable, and we've seen that especially with companies like VGP, WDP, and Prologis even as we move forward. Looking at the performance in the US, what we had for the first time last year since 2004 was regional malls being the top performer and returning 92% in a year. So this is your Simons of the world. Quite a phenomenal performance. It's been a long time since we've seen that. They have recovered past where they started off from the COVID period, but really the best-in-class ones are the ones that have done that. Those who are on middling, sort of not really providing the best type of assets, they have lagged a little bit. But it's really, if you've got the best assets in the best places where people do want to go, they still do want to go to malls, they still do want to do physical shopping. We had that coming through. Self-storage as well, as I mentioned, very, very strong performance coming through last year. You know, if you know anything about the way that North Americans live, is they'll all have car garages, which will all be full of stuff. The cars will be parked outside, and then they'll still have everything sitting in a storage thing as well, and that's carried on. And you start to see Europe starting to catch up to this as well. So very strong performance in the UK and in Europe too, and then all the way down to healthcare, which is carried on remaining under pressure. So looking at 2022, it's definitely been a lot more challenging than the start of last year. Index down by about 9%. Retail again leading the way. We started to see results coming through which have remained pretty strong, just with the negative sort of sentiment in the market at the moment is companies reporting phenomenal returns like Prologis are not seeing that bid up that you would expect, but very similar to what we saw last year. So what we expect is as the market starts to, I think, return to a little bit more stability, as we start to see what the potential of rates are going to be, we should start to see those start to bounce. Our sector outlook, we remain very positive on industrial on a global basis. Retail, we start to think it will continue to be positive, especially in the US, Europe, and the UK, a bit less in China and Japan. Office still our least preferred sector. We think it will return to normality, but it's going to take a while. Residential still in most markets, very strong, good growth, very strong demand. Healthcare starting to return to normal, especially on the senior housing side. As the vaccination process moves through, everyone's double vaxxed, triple vaxxed. We've got the pills that have come through as well, which have made a very big difference too. We'll start to see healthcare recover. Storage, after the very strong run on last year, is probably, we're not expecting it to continue that into this year, so largely neutral on that. And then specialized, very similar as well, very strong runs, but losing a little bit of steam. Everyone worries about the impact of rates on REITs. We have a study that we've been running the data on going back to 1976, which I'm sure none of you remember the 70s, but a period of pretty high rates, stagflation at times. And what we typically see whenever we have rates moving up is that REITs do tend to underperform general equities. What we then have is about 6 months post this and a year post this is we have very strong performance coming through from the REITs. They sold off in general anticipation. Economic fundamentals typically come through. There's good growth, and they then really start to deliver excess performance versus equities as we go forward, which is great. Also, when we have a look at the balance sheets of companies at the moment, we're seeing interest expenses are smaller and smaller parts. Companies have changed their balance sheets from the way they were in 2008. They've moved out the terms to maturity of the debt they have. They've also fixed and hedged, this is in Europe, the bulk of their debt. So movements in rates don't actually have as much impact as people generally assume that they will have. And it's also the same with the length of maturity that they have as well on these hedges. It's not the short-term impact that people are expecting to happen when rates start to move up. Also, we have a recent study that Cushman & Wakefield did, and what they looked at is what happens over 40 years of data also is when there's a 1% increase in inflation, they see about a 4.5% increase in total returns over that period. And you see that going through again, also depends very much on the sector as well, but very strong movements, especially on residential, industrial, and retail on that, and a bit less on office and hotels. So the important thing for us again is we want to keep getting the message through that real estate is an inflation hedge. Typically, as prices rise, we do see asset prices rise too. We also see long-term leases will typically have boosters built in to deal with inflation. Short-term leases can actually can take a more even quicker advantage of movements in CPI and increase their rentals. We also see dividend growth has remained very strong and resilient with most REITs over 20, 30 years of study is typically you find that there's a very low probability that dividends are going to decrease, and more than likely they will continue to actually increase and keep pace with inflation. Our outlook, we do expect growth to continue. We do expect Asia and Europe to start to catch up to the US from the US's fabulous performance last year. Inflation is going to be with us for at least the first half of the year. Maybe as things start to ease up in the second half of the year, we should see it start to ease also as rates start to come through, and hopefully that works. The pandemic is not going away. I think the real difficult bit for central banks is going to be to make sure they can deal with inflation without inducing a recession. If there's a recession, this does change how things move. Again, with REITs, remember, not all sectors perform the same way as those, and we do believe that those that will continue to outperform are going to be those that have pricing power, that have in-demand sectors, and those that have the strongest balance sheet. So in general, we remain pretty convinced that our asset class will continue to offer you an attractive hedge against inflation. It's going to provide good, robust total returns and continuing long-term profitability and growth for investors. And thank you so much for joining us today.
Richard, great. Thank you so very much for that. Very good presentations. Maybe just to mention to the audience as well, Richard, you guys also manage the Select BCI Worldwide Flexible Fund, which subsequently also won a Raging Bull Award. So if you're looking for a mandate that's a little bit more flexible, other than the pure global equity mandate, there's another one to look at. Maybe just a quick question from the audience, and Gareth, this is directed to you. There's actually two questions for you. But just very quickly, and it's got to do with regards to holding global property in a client's portfolio as an uncorrelated asset class. So maybe, is that asset class, going forward still offer diversification or disconnected to global equity? And maybe a little bit tougher one, I know you're going to say 100%, but what percentage should a client hold in terms of global property?
It's going. So yes, it still is largely an uncorrelated asset class with general equities. The performance typically compares very well over long periods of time. We've done a lot of work as well at looking at what the benefits are of having REITs in a portfolio over long periods of time. There have been many studies on this that have been done over looking at data going back about 50 years. And typically, by adding in REITs to a portfolio, you do generally get better performance with lower volatility as compared to just general equities. The size that you want to have, the studies and our work can show at times it can range from anywhere from about 5 to 30%. Typically, actually, when you're adding larger and larger amounts into it, it actually does, because of the performance of the asset class, actually does perform better. We're not, though, saying that you should add 30%, but we should say at a minimum, you should at least in every portfolio be having at least about a 5% plus allocation to global property to get the benefits of the asset class for your investors.
Yeah, I think that answers it. Maybe just one very last question from my side, and Richard and Gareth, I'm going to direct it to both of you. I know it's very difficult to look at the world and position portfolios on what if things, but it's very much in our faces for the past month or so. The whole Ukraine-Russia debacle, how it's going to play out, we still don't know. So, like I'm saying, it's a big what-if scenario. But what does a world economy look like in a war-type environment? And could there be reaction on portfolio construction as well? Richard, if you maybe want to go first.
Must we
Yep.
spray this? So, okay, the first thing is it's great to be on the tip of Africa if there's going to be war in the Ukraine. If it's going to be something really, really big, then our portfolios are the kind of last thing we have to worry about. Okay. So let's assume it's not going to be that. If there are skirmishes and stock markets fall, then it's self-evident that all you must do is buy more equities and more properties if they fall. I mean, that's self-evident. So, I think there are always these things, and it's tried to say, but obviously it's easy for us to look at long-term charts, and we've all seen the charts. The last 100 years in the stock market, how many events there have been, Cuban Missile crises. There's been a lot of issues, and there's been a relentless march upward in investments for people who committed to investing. So personally, I don't think it's worth too much thought, not to be flippant about it, because I think it's very tactical. And I think when you invest, you should be thinking more strategically. I'm sorry, I don't really answer your question that well.
No, it does. Thanks.
I think our opinion really on there are a couple of governments around the world whose focus really is on their survivability, and foremost amongst those are places like North Korea, China, and Russia. They have a very strong focus on staying in power, and at times we might think they might be a little crazy, but they're very rational when it comes to that overreaching and overriding requirement. So I think the odds are not zero that Russia does something extremely stupid, but I think they are closer to zero than they are to 90. Personally, I think that there's certain parts of this have been blown out of proportion. Putin is trying to get certain concessions out of the West. Is he willing to risk his presidency, his power, and his country's economy to go to war over Ukraine? I think the odds are very low. Again, not zero. If something does start, it probably will be pretty localized. You can look at their general reactions. You would have had a few years back, you had Turkey shot down a Russian plane involved in bombing in Syria. The Russian response was very, very muted, very low. They are careful about going a little too far. But if it does happen, you know, we don't have any exposure to Ukraine. We'll probably cut some of our exposure to Germany and put more into the US, which again, like South Africa in a way, is geographically distant from almost any conflict globally, the way it always has been. So yes, these become opportunities to buy, and you know, as with most equity classes, you know, as an investor, your time horizon should always be at a minimum 3 years plus. You know, you can't be popping in and out of these things. So these short-term movements are great opportunities to add. Just put your money and just let the markets do what they do best, and that is grow over time.
Yeah, happy with that. Richard, Gareth, thank you very much for that. We're very much out of time, and thank you for joining us here today. We've got a very big audience watching you as well, and really good to see your funds are doing extremely well and continue to do so. Next up, or the next session we've got is on local bonds, and I'm going to call Nolan and Ruan to the stage, and we can start with that. SA bonds also very topical. It's one of the better performing asset classes over the past 12 months. It served our clients very well. You'll see a lot of his bonds in fixed income portfolios as well, but we specifically to focus now on bonds. Ruan on the stage now from Argon Asset Management, and Nolan, who you're familiar with from Anchor. Gentlemen, thank you very much for joining us. We a little bit short on time. We're going to steal some from tea time, so you still get your full-time slots. I'll make sure we run on time for the rest of the day. And Nolan, you're up first. Thank you very much. Appreciate it.
Thanks very much, Eugene. Eugene, in the interests of time, I'm a little bit out of practice of standing up here on stage. It's been a couple of years. So wonderful to be back, but just give me a 5-minute warning so I can kind of sort of maybe get close. I'm good for a quarter CPD point, and I don't want to steal people's time. In terms of fixed income, Richard was up here, and basically it's an upside down world. The equity guys stood up here, and Richard spoke all about interest rates, inflation, all the fun things. And I thought, well, you know, I'm the fixed income guy, so if Richard's going to talk about fixed income, what do I talk about? Let's talk about Facebook shares as the bond presentation to get started. And I chose the Facebook shares because you've got a chart there on the right. I just snapped it off a quick Google search. But the point I'm making is that last week, Facebook shares dropped 20% odd. We all saw that. And what I want to look at is why it dropped. It had nothing to do with interest rates, absolutely zero. It was all about the fact that their user numbers declined. User numbers missed. We've got concerns about the future earnings, and that is what caused the sell-off of shares. And that's actually a very important point, because rising interest rates are hurting share prices. Rising interest rates was very much a 2021 story, actually. In terms of 2022, the narrative has been shifting, and it's been shifting quite a lot, actually, from about mid-January, and it continues to shift. People are actually more concerned about growth rates, economic growth rates. People are concerned about earnings growth rates, incidentally, on the equity side. But I'm going to talk fixed income. I'm going to talk economic growth rates. And the reason for this is that the markets tend to be quite myopic. They tend to only look out for the next 12 months or so. And if we look out for the next 12 months, what are we going to see? So we went and looked at the IMF numbers for economic growth rates last year, economic growth rates next year. And basically what you can see is the dark blue towers, economic growth rates last year, and we're going to slow the economies down to the light blue towers. And depending on who your economy is, the slowdown is greater or lesser. That's actually quite a stark slowdown. I mean, the analogy I'd use for the USA, you know, economically growing at 6%, that's like a car doing 180 kilometers an hour down the highway. The light blue bar where we're going to be by year end is that same car is now going to be doing 50 kilometers an hour. There's only one way you do that. You've got to hit the brakes, and you've got to hit the brakes hard. We've got screeching tires, we've got smoke coming out the back. You're sitting there, it feels like your eyes are sort of getting sucked out the front of your face as this car slows down. That is what the economic environment is going to feel like in the next year. That is what's going to drive fund performances for the next 12 months. So if we look at that and think about what does that mean for my fixed income portfolios, let's talk inflation for a second. And I'm actually doing a big presentation online on inflation on the 24th. I didn't want to talk inflation, I wanted to talk something else. If you do want to watch the Anchor webinar essentials on inflation, email Eugene, email me. We'll make sure you get an invite, and we'll unpack inflation for you in a bit more detail. But for now, basically, this massive slowdown, what does it mean? Well, imagine your earnings are going up by 6-7% per annum, which is kind of what's happening in the States right now. Your economic growth is about that. And suddenly it's only going up 2%. There's this sort of wealth factor that disappears. I don't feel, knowing that I'm going to earn 6% more next year, I'm a little bit more excited to spend money. That disappears. I naturally just rein it in. It's a psychological factor. So it's going to start to play on demand. We expect demand will start to slow down in line with the greater economy. And And the other factor we're going to see is the demand is going to start to shift. It's been very centered around goods because, travel, restaurants and that is less available during a pandemic. We expect that the wallet share of services will also increase, again, slowing demand. So we expect a slowing demand environment globally right now. Secondly, though, the other point that I think Richard was making is that we do expect supply chains to start to ease up further. So we expect people to get back to work. We expect that ports will start to unload ships more quickly. We expect that inventories, and there's been will kind of start to restock. So you should have increased supply of goods as less and less people are forced to stay away from work, and that enables firstly manufacture and secondly delivery. So what do you got? You've got a world where demand is probably going to slow down. You've got a world where supply is probably going to increase, kind of the opposite of what we saw last year. It's the recipe for slowing inflation. How much is it going to slow? I don't know. But the point is, it definitely is going to slow. So let's think about this world with from a global bond perspective, where you've got inflation that naturally is slowing down. You've got base effects slowing inflation down as well, and at the same time, you've got an economy that feels like it's got massive handbrake on right now. There's a structural limit to how high interest rates can go. And we're all sitting here right now speculating about, will the US 10-year bond go to 1.94% or 1.96%? Kind of who cares? It's like arguing, is the car going to do 181 or 180 kilometers an hour? Doesn't matter. It's going to be doing 50 k's an hour by the end of the year. Let's focus on that. And that's what we need to be focused on. So when we look at the world then, what you've really got is the normalization of interest rates. So we've got a chart in front of us, and that's Anchor's views of where the US bond yields should be trading. The red line is kind of where we think the market should be, and the market never listens to us, but the blue line is where the market actually was. And basically what you can see right at the end there is we think the fair yield on a US bond is about 1.9%. It's actually where the yields were before we went into COVID, and we're now going to probably see yields push above. In fact, they have pushed slightly above our 1.9. Not impossible they go higher. However, the point is, by year end, all of these factors that are driving rates higher right now have changed direction. They're pulling rates down. Massive underpin for rates. So a lot of the rising rates are done. Not impossible they're going to go higher. Certainly, I expect they could in the short term, but there is a structural limit to how high they go. And in this type of environment, you've actually got an underpin to bond prices. In the States, unfortunately, bonds are going to be volatile. I think you're earning 1.9% on bonds. Just not that exciting for 1.9%. Invest elsewhere when you're offshore. I wouldn't rush to offshore income. But let's talk about the domestic environment instead, with the understanding that there is going to be a sort of floor on rates. And the point domestically is that South African bonds are cheap. And I can stand up here for the next hour and talk about a variety of different measures as to why they're cheap. The thing is, Eugene's going to have a heart attack, so I need to get a bit of a move on here. And in terms of South African bonds, I've got a chart here which basically looks at what the rates market is pricing in for interest rate hikes over different time periods. And I'm looking at the bar that I've colored in there to the 13th of January 2023. And at the time, the rates market was pricing in 2.25% of interest rate hikes between now or between 13 Jan 21 or 22 and 23. So it was saying over the next year, you're going to get 2.25% of interest rate hikes. We've had 0.25% of interest rate hikes, so the market was pricing in another 2% of rate hikes. That is a very, very extreme scenario. That's basically the type of scenario where the market is saying the Reserve Bank is going to hike at every meeting this year. And to be honest, that doesn't get you to 2% rate hikes anyway. It needs to hike by more than 0.25%. So you're going to have some hikes of 0.5%, some hikes of 0.25%, and every year there's a hike. That's what the market's pricing in. That's not going to happen. To get to that type of environment, I need to put some very, very extreme scenarios into any model. Any normal model with sort of 90% sort of probability confidence levels is going to say to you, yes, interest rates are going up. Interest rates are going up by another percent. And then remember this underpin that I was talking about earlier. That underpin is going to kick in. It's going to hold us back from massive, massive rate hikes. You've got 2% of rate hikes in the market. You're actually only going to experience 1% of rate hikes. What does that mean? It means the market's priced in too many rate hikes. And as it pulls back from that, you've got a propensity for capital gains on bonds. So fixed income right now is looking particularly attractive domestically just because it got too negative on rate hikes. And that continues to be the situation right now. Moving forward, though, the other point I constantly get asked, and it's the sort of point I'm going to end off with, is what about rising rates offshore? We expect US interest rates are going up. Surely that means South African bonds are going to be impacted. Surely it's a massive headwind for SA bonds. Yeah, maybe, probably not. And what you've got here is a chart with a red line on top that is the yield on the South African 10-year bond. And at the bottom, you've got the blue sort of band, which was the yield on the US 10-year bond. Point is, if you look across that to January 2020, what you will see is that the difference between the two, that sort of shaded area, widened out dramatically as South African interest rates, bond yields went up, and the US bond yields went down. So this massive widening that took place through COVID, as interest rates normalize, actually that margin, that difference between the two, should start to narrow as well. And in fact, if that normalizes, there are massive capital gains on SA bonds. SA bonds are cheap. And another way of looking at this actually is to say that, if you look at inflation globally right now, what I've taken is South African inflation rates minus the US inflation rates. And you can see actually the different Reserve Bank governors. So August 13 to sort of May 16, you had Jill Marcus as governor of the Reserve Bank, sort of managed SA inflation to be about 6%, US was about 2%, the difference is about 4%, and bond prices sort of made a lot of sense. In came Kganyago, and he decided to move South Africa's target rate from 6% to 4.5%. Did that very, very effectively, and you can kind of see as he did that, 4.5% SA inflation minus 2% US inflation differential is about 2.5%. You can kind of see how it moved down, and then it was tracking broadly sideways as he managed us to a lower inflation target. Exactly what happened. Thing is, through the pandemic now, US inflation did get a bit out of control. It's going to be higher than South African inflation, probably for much of the year as such. And if you take South African inflation minus US inflation, it's now negative, i.e. inflation is lower in South Africa. And that's got a lot of profound impacts, one of which, by the way, is it actually means the rand should continue to strengthen. But another profound effect it's got is that this bond differential that I had on the previous slide, I do have a backwards button, makes absolutely no sense. The country with a higher inflation rate should have higher bond yields, all else being equal. This is completely upside down, and it's very difficult to actually economically justify in this type of world why this differential should be wider and not narrower. And that's one of the key points right now. It's economically we're in a world that actually would support South African bonds naturally if it weren't for the fear factor around the South African government. And that in itself, coupled with all the other factors I've mentioned, means that you're getting to this point where there's just this incredible potential value unlock in SA bonds, and you've got to be invested for it. So what do we do about it? Well, first thing we're doing is we're overweight bonds. Like the asset class, I think it makes a heck of a lot of sense at current pricing. I think it makes a heck of a lot of sense at this point in the economic cycle. So, that's how we're thinking about bonds, be overweight bonds. Secondly, not all bonds are equal, and focus on those bonds that are going to gain most from this massive deceleration that we're going to see. Some bonds are going to benefit more than others, and you want to kind of pick the right bonds in the yield curve. We're putting a lot of effort into that. We're picking the bonds that are going to show the greatest gains, we think, and that actually speaks very well to our portfolio. And then be patient. This car is doing 180 k's an hour. It might do 185 before it has to hit the brakes. Might be a couple of negative months as a result. Doesn't matter. We all know where that car is going to be at year end, and that car is going to be doing the 50 k's an hour. Position for the big deceleration, not the last 5 k's of acceleration. So that's how we're positioning. That's how we're thinking about bonds right now. And I'm going to end it here, but I'm going to ask you one thing. Each time over the next year, when you hear people talk about decelerating economic growth, slowing economic growth, slowing equity earnings, and all the other things that you are going to be hearing about, just think about the Anchor BCI bond fund. We're positioned exactly for that. Thank you.
Thank you. It's an interesting little device here. It looks like a buy and sell button, something I'm very used to. My name is Rui Naidu. Today I'm representing my firm, Argon Asset Management. Argon has been around for about 15 years, running bond funds, flexible income funds, money market funds. We also have equity funds, and then multi-asset products such as absolute return and balanced funds. But today, as you know, we're talking about South African government bonds specifically, and we're going to talk a little bit about inflation. So as we're all aware, inflation is high across the globe, and we're seeing US inflation at around 7%. Target inflation in the US is 2%. So we are above target in most major economic regions except for Japan and Switzerland. At the same time, inflation is forecasted again for the next 12 months to be ahead of these target bands or target points, while policy rates are extremely low, historically low. So that means we're running very negative real interest rates, which is extremely accommodative monetary policy, while money supply is growing rapidly. Just a closer look at US inflation at 7% and the breakdown of its components. In green, quite suitably, that's energy, not green energy, but old, dirty energy, which is a big contributor to inflation upside surprises in the US. Part of the story, or a lot of the story, is to do with the transition into net zero carbon emissions and all the supply constraints that come with that. And that's a story we should expect to continue to play out into the future. That's a longer term story. The network for greening the financial system, a bunch of banks, they estimate that it will cost $160 per remaining ton of excess carbon to be eliminated. The US currently emits about 240 tons per $1 million of expenditure. Back of the envelope calculation, that suggests it's going to cost about 4% in CPI terms to green the economy, to fight climate change. So it depends on what pace this happens. If it has to happen front-loaded, that's going to be quite a shock to the system. But even if it's gradual over the next decade, we're talking about a 0.4% increase in inflation per year. So this is a sustainable problem that we're going to be fighting. Of course, it's better than doing nothing. The mustard line is food inflation, not much to speak of there. But the other interesting one is the orange, which represents goods inflation, which has been a big driver of inflation this year and last year. And why is that? Well, of course, we've had a shift in preferences given COVID. People have stopped spending as much on services or were unable to spend on services and diverted some of those paychecks that they got from government towards goods. And I like Nolan's example of a car firing down the road, and the global economy is a lot like an engine as well. Oftentimes inflation is a function of that engine overheating, the economy running very hard. What we're seeing here, supply-constrained inflation, so that's like the engine is misfiring, it's sputtering along. And that's what we saw in the goods sector. Supply takes a long time to come back online. And then we have services inflation. At the same time, if you have a diversion of demand from services to goods, you should expect services inflation to fall. The problem was we had a lot of people retiring, leaving the labor force, specifically in your contact-intensive types of roles like leisure, hospitality. So services companies were then struck with falling demand, but at the same time a labor shortage and rising labor costs. So therefore we had this lift in inflation quite broadly. The US Fed has some underlying measures of where inflation is, because you could get certain outliers in CPI data. So what they look at is cross-correlations of the components of CPI. That's the turquoise dashed line. And then they have another measure that takes into account certain macro factors. That's your solid turquoise line. They diverge from each other at times, but both now sitting much higher than they have since the inception of this series. And the Cleveland Fed has a nowcasting for CPI, which they see at 7.3. The number will be released tomorrow. Economists are also expecting a rise to 7.3. Remember, we all expected inflation to be falling this year. Inflation was supposed to be transitory. The supply factors were supposed to fade away this year. They have not. The cumulative surprise in inflation is just astronomical over the last 12 months. Again, global supply chains. This is an index generated by the Federal Reserve Bank of New York, a global supply chain pressure index. And there you can see quite clearly what supply chain pressure looks like. It is potentially turning around, so hopefully that comes back. And China PPI has turned the corner, and US CPI does tend to have some sort of correlation with Chinese producer price inflation. Now looking back at this long-term history in inflation, at 7% US CPI, we're sitting back at a level of inflation that was last seen in 1982. Exceptionally high inflation, and this is after a period of low falling inflation in which central banks around the world were struggling with the problem of how do we lift inflation? How do we get inflation expectations to rise? It's ironic now because they're going to be fighting the opposite battle. How do you get inflation expectations not to entrench at a 6% handle? Some of the reasons for the secular decline in inflation that we experienced over the last few decades are secular stories like demographics and globalization. The UN data suggests that from 1990 to 2020, the opening up of the Chinese economy injected a labor force of 240 million people into the global supply chain. That's a downward force of inflation. But demographics now are turning around, and Chinese population, European populations are now aging, which means the labor force will be growing at a much slower pace, which means upside pressure on inflation. The other main factor driving inflation lower, and which disrupted many economists' models, like the Phillips curve, etc., was that of globalization. What mattered was how open your economy is and what was the global supply of labor and goods. In this new world, where we move away from just-in-time optimized supply chains to now just-in-case supply chains, companies have learned the lesson from COVID and they've reshored a lot of production. We're going to see continued headwinds from deglobalization on inflation. Now, overlaying on this long-term history, the US Treasury, the federal funds policy rate, we see policy rates extremely low, obviously at historical lows as we were fighting effects on the economy of COVID. The real Fed funds rate, this is just a simple measure that takes where the Fed policy rate is now minus where inflation has been over the last 12 months, or 12-month year-on-year change in inflation. And we're sitting at minus 5%, again, deeply negative, deeply accommodative. But that's not the full story. There's a shadow Fed funds rate that you can use. This takes into account not only the Fed funds policy rate, but also the other unconventional measures that they've adopted, such as balance sheet expansion, etc., buying treasury bonds. And that gives us a shadow rate. So the real Fed funds shadow rate is now at all-time low of minus 6.6%. Speaking of that balance sheet expansion, this is a chart of the US Fed's total assets. Started to rise, of course, in 2008 when they first adopted long-term asset purchases, more commonly known as quantitative easing. So they rapidly increased that balance sheet up until around 2017 when they decided that due to political economy constraints, they needed to shrink the balance sheet. They went on, they tried their best to do that until money markets started to hiccup and sputter in 2019, and they began increasing the balance sheet again, and this was before COVID really hit. And then we saw this massive increase from under 4 trillion to now sitting at almost 9 trillion of asset purchases that this bank has done. And now the Federal Reserve has had a FOMC meeting, that's a policy meeting in January, and they've confirmed that they're going to be reducing the size of this balance sheet. How are they going to do that? They're going to let the bonds that they've bought mature, expire. If you look at how many bonds they have expiring over the next 1 year, they've got about $1 trillion worth of bonds. So that's a maximum reduction that we could see from the Fed if they go down that path. This is a withdrawal of liquidity. This is not good for asset prices across the globe. So what's the market pricing in right now? In the US Fed funds futures market is implying 5 rate hikes from the Fed over the next 1 year. In December, the Fed told us we should expect 3 hikes, or indicated 3 hikes for 2022. By the time of the meeting in January, the market had moved on to 4 hikes. The Fed governor did not push back against the 4-hike pricing by the market. He did not push back against the argument for a hike at every meeting, and neither did he push back against the argument for a 50 basis point hike at any specific meeting. The Fed is very, very afraid of inflation being stuck at these high levels. Of course, they're in a very difficult spot because, again, this is not an overheating engine where policy rates can easily bring back inflation. This is about supply constraints and supply chains. Another place where we can see this pricing in of hawkish central banks rising interest rates is in the quantity of negative yielding debt across the globe. This is a very strange concept introduced mainly by the Europeans and Japanese, negative interest rates, with many, many distortions. So this number is at around 20 trillion. It's now back at around 7 trillion. So the bond market has been pricing in this tightening by eliminating this nonsense of negative interest rates. This should have some positive effects. Negative interest rates had many side effects. Conversely, it led people to save more because interest rates were lower when they were trying to get the opposite effect. It caused pension funds to have go into deficit and buy riskier bonds across the globe. Various side effects of negative yielding debt that we're pleased should disappear as this normalizes. Another area where we can see this hawkishness and being priced is in US financial conditions. This is the Goldman Sachs Financial Conditions Index. The way to read it is, as this number rises, we're talking about tightening financial conditions, market stress. So financial conditions obviously were extremely easy on the back of all the liquidity injections in the market, low interest rates. We're starting to see that rise. The chart on the bottom panel, the white line, that represents a 20-day rate of change of financial conditions, and we can see the speed of this tightening has been remarkable. We've last seen this type of tightening, or the speed of tightening, in 2020 with the COVID crisis, and then previously in 2018 when the Fed was underway with its asset reduction or balance sheet reduction process. So the market has been pricing tightening, and it's done it very rapidly over the last few weeks. At the FOMC meeting, Chair Powell spoke a lot about the differences between now and the last time they had to tighten monetary policy. This was within the context of answering questions about the pace of tightening, the quantum of tightening. He was very suggestive that we should expect a much faster pace of tightening than we saw in the 2015-2017 cycle. GDP growth is now at 5% versus 2.2%. Unemployment rate is lower. We're seeing much higher inflation as we've seen. The balance sheet is almost twice as big as it was back then, and the fiscal deficit is almost 4 times as large as it was in the previous cycle. So buckle up for the next hiking cycle. Again, thinking a little bit about this liquidity withdrawal. Liquidity injections buoyed the financial market. It pushed up equity prices. It generated remarkable returns that we've seen in 2021. Surprising returns we'd seen in 2020 when the global economy was mostly shut down. So surely liquidity withdrawal should have the opposite effect. At the moment, the panel at the bottom shows you that the balance sheet is growing at around 20% year on year. If that 1 trillion that is due to expire this year is completely rolled off, that would represent a contraction on the balance sheet of minus 12%, which takes you to the minimum balance sheet growth that you see there we last saw in 2019. That was a major problem for the markets. In 2018, when the Fed was withdrawing liquidity from the system, the best place to be was cash. All asset classes performed poorly. Of course, we did have the Trump trade war at that time, which conflated things, but liquidity still matters. Again, to try and get an idea of what this quantum of liquidity withdrawal is going to be, we look at this liquidity draining operation that the Fed does. Now, this is a little bit strange and confusing, but the Fed is injecting liquidity in the system with one hand, trying to maintain a certain policy rate and then change that policy rate over time. But at the same time, they've injected so much of liquidity in the system that the floor becomes leaky and the policy rate is impossible to maintain. So what they've got to do is, while they're injecting liquidity here, they've got to absorb some of the excess liquidity that the money markets are flooded with. So they do this through this repo operation. And they had done it in 2017 and 2016 as well, but to much smaller scale. As you see there in 2017, it was less than 500 billion. At the moment, they are receiving about 1.6 trillion dollars every day of excess liquidity. Now, what the Fed does is it pays these institutions an interest rate on these amounts, and that interest rate is related to the policy rate. So as the Fed increases the policy rate, they're going to have to be paying money markets more and more just to make their monetary policy transmission effective. Now, dumping money into money market funds on the back of your implementation framework is politically sensitive. So the Fed really wants to get this down to zero, and getting it down close to zero requires a 1.6 trillion withdrawal of liquidity, which is going to be absolutely devastating for financial markets if they were to go that full way. But this is just to give you an idea of the quantum of potential liquidity withdrawal. So have the markets priced this in? You see 2013, a huge tick up in these US tips. These are 10-year inflation-linked bonds. This year, we've seen a moderate increase. This is the risk-free real rate of the globe, the 10-year risk-free real rate. So how does it affect South African government bonds? This comes from one of our very powerful proprietary tools that we have at Argon. It's called our Tactical Asset Allocation Dashboard. What we do here is we look back at as much data as we can find for each asset class. In this case, all bond index returns. And you see the distribution of annual returns or rolling 12-month returns in the blue distribution. So on average, around 9%, 9 to 9.6% return. But how do bonds perform if you condition them to a situation where US tips are rising by 50 basis points or more, and you see the distribution shifts way to the left? And this is a statistically significant difference in the means that you're seeing here. So your return from bonds is expected to be about half that what you would get in normal times if Treasury yields have to rise to price in this liquidity withdrawal. So we're a little bit concerned about bonds at this stage. The Argon Bond Fund has performed quite well over time. We started in 2018 with the Class B fund. It ranked first in its first year, first in its second year, and then 14th and 10th in the subsequent years. When we look back at this fund, it's outperformed its benchmark on the composite through inception. Again, I remind you, we've been running this fund for 15 years. So outperforming its benchmark in all time horizons. And an interesting thing to note is that when the bond market is falling, this fund outperforms that falling bond market 75% of the time. So this is a very safe bet if you need to have an allocation to government bonds or need to have an allocation to the bond market, which one should argue you should, because bonds are cheap. They do offer 10% yields. We are getting liquidity withdrawals that will hurt risk assets. So one does need some bonds. The safest place to be when bonds are falling, and you do still need bonds, would be the Argonne BCI bond fund. Thank you.
Yeah, fantastic. Absolutely great, Ruan and Nolan. Thank you very much for that. A couple of questions from our audience. I'm going to try to cover it very, very quickly. I'm going to steal a little bit from D-Town. Maybe, and Nolan, you can help me on this. Positive on bonds outlook, markets pricing in more rate hikes than what's probably going to take place. So we know we're all very bullish on bonds. But here's the thing. My understanding of it is a pure bond fund are probably going to be a lot more bumpy during 2022 relative to a flexible fixed income fund, which you guys also run. But the question from the audience is, which would give you the better outcome over the next 12 months?
Hi there. I assume I'm turned on here. Yes, yes. So your flexible, the South African bond yield curve is incredibly steep. So what we're basically saying is, if I'm investing overnight, I'm earning about 4% on interest income, and if I push it out to a 10-year bond, I'm somewhere between about 9.5%, 10%. So there's a massive pickup in yield for investing for a little bit further out, but you pick up potential volatility. So first point is, as we go through the structural adjustments we we're just talking about, everything is going to be volatile. I think 2022 is going to be a volatile year. We've seen it in equities. We are going to see it in all asset classes. That being said, what we're thinking at the moment is that the yield pickup in bonds, so if I go into a flex income portfolio, my starting point is a 4% sort of foundation, and then I'm trying to build on top of it to get higher yields. I can maybe get you to a portfolio of yield of about 7%. To get more than that, frankly, I've got to put bonds in there anyway. So we think that the 10% on bonds right now as a starting point is actually quite attractive, and it still gives you, I still think I'm quite positive on bonds. I think that the global environment of slowing economic growth is going to turn out to be SA bond positive, and that's okay if I'm wrong. Those 3%, 4% of extra yield that I'm earning over a flexible income fund gives me a massive cushion anyway to absorb potentially the fact that I might be wrong. So on a risk-adjusted basis, I'm going to go bond funds all the way.
Thanks for that, Nolan. Ruan, maybe your bond fund, we've seen the numbers doing extremely well. So if clients want a little bit more oomph in their fixed income, I think Nolan answered that, look at adding a little bit more bonds, so maybe look at your fund. The Orbi, I think it's sitting on average at about 7 years. In your bond fund, where do you find more opportunities on the longer side, shorter side?
Thanks. Yeah, so we're very tactical on yield curve positioning. It tends to be one of the strategies underlying the alpha sources in the fund. So we have directional alpha sources, we have credit, and then we have yield curve. At the moment, the back end of the yield curve, we're a little bit concerned going into budget. There could be some negative risks coming out of the budget, so we, underweight at the moment. But that could change. The back end is where the real juice is. We have an extremely steep yield curve. So when we get bullish on bonds, we typically tend to be overweight the back end. But at the moment, as we're underweight, slightly short duration, we will be underweight.
Ruan, you spoke, thank you very much for that. Happy with that. You spoke a lot about the US yield curve as well. But if you look at the US yield curve at the moment, your short-term yields are quite steep, but the longer-dated yields, they're dropping off quite fast. Does that signal a global recession?
Yeah, so the most often referenced spread is the 2-year versus the 10-year spread, which sits at around 60 basis points. So that's still positive. It's only once that goes into negative territory that you start to get that signal of an impending recession. And even then, it still takes 6 to 18 months before that recession begins. So not quite yet. A slowing growth is quite likely, as Nolan says, but we're not in recession territory in terms of market pricing yet.
No panic buttons yet. Good answer with that. Thank you very much. Last question to Nolan, just very quickly. And it's got to do with inflation. We spoke a little bit about inflation. Last year, we heard that big word transitory, SA globally. We know that SA inflation is not consumer driven, right? And it's more to do with structural Eskom, oil prices, all that nonsense. But the question I think rather is, how long do you think, have we seen the peak of SA inflation, or is it something that can last maybe a little bit longer, pushing SARB to be a little bit more aggressive maybe?
Sure. So first comment is Anchor's doing a webinar on inflation, 24th. Please email Eugene.
We got that.
The second comment is that South African inflation is being pushed, as you say, by two things. It's being pushed by exogenous factors, i.e. the oil price, and secondly, it's in government inefficiency. I mean, that's what it is. Oil price was up 50% last year, and that's a major driver of the current inflation. Year to date, it's up about 16%, but the point is for it to do 50%, it needs to go to like 120, 130 per barrel, very, very extreme scenarios. Yeah, there are a couple of guys out there projecting it, but likely we're getting towards the top end of the oil pressure on inflation. So naturally that component tapers off. The government inefficiency one is probably the bigger concern, and it's also a challenge for the Reserve Bank. I don't know how many rate hikes from the Reserve Bank make Eskom produce electricity. But basically where you're at is that this push inflation is being put through the system, and the Reserve Bank's being forced to kind of, almost hamstring the rest of the economy, kind of balance it out. I think that's going to be with us for a while. Structurally, our push inflation has been with us for a while. I think the economy is dealing with that. I think it's going to continue to deal with it. But the rest of the economy is so soft that it counterbalances it quite nicely. And you probably end up with inflation, as the Reserve Bank says, somewhere around the 4.5% to 4.8% on average, which is an okay outcome, albeit it's quite depressing when you dig into the detail.
Gentlemen, thank you very much for that. We're very much out of time. To our audience here, we're going to break for tea, and to our virtual audience as well. I'm going to stick to we're a little bit into tea time, but we're going to start sharply again at 10:45, and our next section will be again flexible fixed income managers and how they position the world based on a lot of information we heard here now. And again, Ruan and Nolan, thank you very much for coming through. Really appreciate it. Thank you. All right. Slides are on there. Yeah, slides are on there. Right, we're all sorted here with virtual sessions. Normally, you can just start like clockwork. I forgot with live sessions, you've got to make sure that everybody's in the room, or they're all here, they're all settled down, everybody's on stage. But we're ready to go. Starting up a little bit later, but it should be fine. Welcoming on stage now is Brandon Blood from Granite. Brandon Quinn from Saffron, and Louis from Fairtree. This is our session. We're going to talk about flexible fixed income. All three managers, I think, phenomenal managers, been around in the flexible fixed income space for many, many years. I think if you put your numbers out there, you're all going to compete very, very strongly. And we're really glad to have you here with us today. I'm not going to keep the audience waiting. Brandon, thank you very much. You're up first, and then we'll just keep going, and we'll do a 5-minute Q&A afterwards. Thank you very much.
Calling all Grenatians, calling the young, the old, and the curious, calling parents, learners, and entrepreneurs, calling those looking into their future, calling the ones with an eye for detail, and those who see the bigger picture.
In 1982, I received a toy garage as a gift for my birthday. Gifts like these were special. There were no Black Friday sales. So we didn't have many toys, we just had a few very good ones.
We built Granite on the same foundation, with a focus on quality, to make sure that what we do endures. When we invest our clients' savings, we do so both to protect and grow those savings.
To achieve this, we only buy companies we can really understand and can comfortably vouch for, and not those that are either get-rich-quick or lose-it-all schemes.
It's not only that we're avoiding the junk, we are also avoiding the mediocre.
We set stubbornly high standards for our investments, settling only for great businesses run by exceptional people we can trust.
It's the same for equity investing as for fixed income investing. We do it together as a single investment team. Not only does it make sense, but we get great joy from working and learning together.
Only once we are satisfied with the quality of the company do we start assessing the price that we should pay for its shares or what price it should pay to borrow from our clients.
We do this as separate processes, deliberately in that order, because we know how easy it can be to justify buying something that's on sale, only for it to break not long after.
Our funds look a little different because we do things a little differently.
Because together, we want to patiently look after people's savings for many generations.
To pass on something special to those that come after us, a legacy of happy clients.
Good morning, everyone. It's It's nice to be presenting in person after a very long time of being out of the market. My name's Bronwyn Blood. I'm one of the founders of Granite. There were only 3 of us that started the business. But as you can see, now we have grown from strength to strength, and we have a lot of multi-talented individuals that are talented beyond just investing money, as you can see from their acting skills. So I'm going to talk to you today about the fund that I manage. It's called the Granite Multi-Income Fund. As you know, the sector invests across the full universe of fixed interest-bearing instruments, including property and pref shares. And the objective in the income space is to deliver real returns in excess of money, market, and traditional income funds, but at much lower volatility. So that's nothing new. This fund was launched on the 1st of April 2016 with some seed capital, and we are now, we've done extremely well. We're very proud to say we're first quartile over all meaningful periods, and the funds under management in the strategy are now at 4.4 billion. The benchmark that we manage ourselves according to is Steffi +1. However, internally we look more closely at Steffi +2 or CPI +3. When the team came together about 2 years ago, because we had multi-asset class investors join our team, we looked at why this fund has been able to be such a consistent performer over time. And I think the performance is on the right, but I won't take you through that. I think the important part of this slide is to take you through the 4 bullet points on the left to show you why we think we've got an edge in the income space. Firstly, we are flexible and nimble, and we diversify across all asset classes in the income space, so we utilize all the asset classes that are available to us, from the very low-risk money market type assets to the riskier listed property and hybrid type assets. Within each asset class, we also make sure that we diversify appropriately, and we follow strict credit committee limits to make sure that not all our eggs are in one basket. Secondly, we utilize duration, but it'll never be a binary bet. And by binary bet, I mean we don't swing for the fences in terms of our duration positioning. It's harvesting yield across the yield curve where we see positive risk compensation in small increments. So we don't invest for binary outcomes. We have a thorough credit process that has proven itself over time. So I myself have been investing since the early 2000s in the credit space. I think we understand it very, very well. We've developed a credit process that now fits very nicely into our investment philosophy, which is the equity portion of our business as well. And then finally, we have a philosophy which is all about risk compensation, so we never ever overpay for an asset. So each and every asset that goes into this fund has to have a positive risk compensation in terms of our valuation models. Otherwise, it won't be appropriate for this fund. I think also to mention that we are very, very focused on risk-adjusted returns. So I think in the income space, it's very important to be cognizant of risk. We're looking for consistent, positive returns over time. What we've done in this slide is just show the Granite Multi-Income Fund against all the little blue stars in this fund, all the other funds in the category, against the category median, and then against the all bond index. Now, this is actually the interesting part. For an income fund to achieve similar returns to the all-B over time, but at much, much lower risk, I think we're very, very pleased to be able to achieve this, particularly in an environment where the yield curve is so steep. We're lucky we've been able to capitalize off those steep or higher returns on the longer end of the yield curve, but at much lower risk. So I think even though we don't use the all-B as a target, this is kind of the outcome of those 4 principles which I've just mentioned. So if we consistently do this over time, I think we're doing our jobs very well. Just to explain how the fund has kind of evolved, as I said, it was launched in 2016. there's two things I want to highlight in the slide. First of all, how the market has changed over time, and secondly, how we have been able to adapt to that changing market space. So hopefully this will illustrate how we utilize all the different asset classes across the fixed income space. So in 2016, we were in an environment with very high real yields and very nice wide credit spreads, and it was almost a no-brainer to be in floating rate credit assets. So we invested heavily in the money market and floating rate credit space, as you can see from that big gray part of the graph. That is kind of the floating rate credit allocation in the fund. But we started to kind of recognize that credit spreads were narrowing and not offering as much value. And as that happened, we reduced our credit duration over time. We went into the crisis with a very low credit duration compared to history, and also had built up quite a bit of cash in the fund in order to kind of take advantage. And I remember kind of around that time thinking, wow, there's just no value in the market at all. Then we had a massive sell-off in the bond market with the COVID crisis hit, and the yield curve steepened significantly. And we were in a position to move our duration quite swiftly, take advantage of that, and move into fixed-rate bonds and inflation linkers. Now you can see that the fund is very nicely and evenly spread across the different asset classes. We could spend hours talking about each and every asset class and where we're seeing value in that asset class. For instance, in fixed rate bonds, we like the belly of the curve, what we do in that area in terms of extracting the duration risk and ending up with a floating rate profile, etc. We could spend hours. But just to say that the fund has moved very much in favor of kind of an equal distribution amongst the asset classes. How we see it going forward is that we'll probably be moving more into floating rate credit and money market type paper, as we do see real yields moving up, and already are finding quite a bit of opportunity in that space. So that's quite exciting. So yeah, that hopefully gives you a flavor of how we've managed this fund over time. This is just an extension of that slide to show how we've harvested returns across the different asset classes. So in 2016, most of it was from floating rate credit, that big gray area, and how that has changed over time, the actual contribution of the different asset classes to the fund returns. Just to mention, the since inception total return, the last bar, shows you that credit or floating rate assets will always be a big portion of this fund. The reason for that is that an income fund needs to have low volatility. As I said, we don't swing for the fences in terms of duration. We will harvest high yields on the yield curve, but make sure that it is appropriately profiled for this fund at the volatility that's appropriate. So that's why that last bar, or since inception, shows that floating rate credit is still a relatively big portion of this fund. And then, just to explain how we think about portfolio construction, we have limits according to each asset class, and this is after many years of analysis of risk-adjusted returns of the different asset class, to keep that volatility at the level that we think is appropriate for an income type investment. So you'll see that floating rate bonds are kind of up to 100%, and then inflation linkers and fixed rate bonds at lower levels. Listed property will only go to 5% in the fund at a maximum, hybrid type investments to 10%, and we keep a maximum duration limit in terms of interest rate risk in the fund at 2%, and that's including our inflation linked portion. So that's just to keep or make sure that there's not any surprises, that we have consistent positive returns, which is exactly what we think investors should be seeking in the income fund space. Is it 5? Okay. Okay, so my last two slides are on the fund positioning. I've kept this very short and sweet because I know we haven't got time, but essentially you can see how the fund is positioned at the moment. I mentioned to you that we have an upper limit of 30% to fixed rate bonds. We're currently at 33%, and that's not a hard limit, it's kind of an internal guideline. So it shows the value we've been finding in fixed rate bonds of late. compared to our floating rate bond portion of 20%. Floating rate bonds have not been giving us the value, as I said, because of the steep yield curve and the very low real yields in the short end. And in actual fact, if you look at the floating rate bond portion compared to historically, it's the lowest it's ever been, so very low. CPI linkers, we really like. We found some great opportunities in inflation-linked bonds, particularly on the short end of the curve. We've also found some inflation-linked credit, where credit is often mispriced, we think, in the inflation-linked space. So in the nominal space, often, credit spreads have been negative or lower than Govy, but in the linker space, it's the opposite. So we've been able to capitalize on that. And also just to mention that we do spend a lot of time looking for opportunities in the secondary market. We don't just exist in the primary market space. We will go scouting around to all avenues to try and find mispriced credit. So I think in that CPI link portion, that's where we've been able to introduce some of that. We have some unlisted credit, a very small portion. There's obviously opportunities in this space, but they are few and far between. Our cash and money market, again, has been the lowest it's ever been, and we have listed property at 2.7. The duration of the fund is close to 2, and that's including ILB, so that's probably, we're at the upper limit that we've ever been. And then our maturity profile has moved out quite significantly, and the duration contribution of the different asset classes, mainly in the form of fixed-rate bonds, would be, very much how we manage this fund in determining where we like bonds across the yield curve. At the moment, we really like the 2030 government bond, so that will be the biggest duration contribution in this fund. And then finally, you can slice and dice income portfolios whichever way you want. This is the way we think is appropriate. We think it explains it quite nicely in terms of our exposure. We have 17, almost 18% in government bonds, 19% in ILBs. A lot of that will be ILB credit type assets, but we do have government assets in there as well. Cash and money market, and then credit fixed rate bonds, credit floating rate bonds, also very low levels compared to history. Pref shares almost at 10%. And then we have a bucket called structured exposure, where we embed derivatives into notes. Depending on our view, we may take a bond position and overlay it with a swap, embed a derivative, depending on if we think the swap curve might be too steep. We are able to capitalize that by earning additional premium on that note. So that's just an example there. We found a lot of good opportunities there lately. SOEs at 8.3%, equity at 2.7%, which is listed property, our unlisted exposure at 1.1%, and then we have a tiny position in offshore. We think that's probably where there's going to be a lot of opportunities going forward. At the moment, and historically, everything in the offshore space we've hedged in this fund back into rands. We're now debating whether it's appropriate to include some currency exposure into this fund, but historically it hasn't been managed with any dollar or other currency exposure. Yeah, so that is basically, in a nutshell, what the fund's all about. I think just to conclude, we believe at Granite we've got a purpose, and our purpose is that we are relentlessly committed to protect and grow our clients' savings, and protect and grow is very pertinent to an income fund type investment. We are an owner-managed business. In other words, every single employee has a shareholding in the business, so we're deeply aligned to our funds and our clients and their outcomes. We will always remain true to our philosophy and process, and I think what's very, very important is that we are very, very focused on risk and not just return. So I hope that's come through in this presentation, that risk is key for us, especially in the income space. And we will continue to do that. Thanks very much.
Okay, there we go.
Yeah, good morning, everyone. Thank you for the opportunity to talk about Saffron and our funds. I was asked to focus somewhat more on the economic view and our view of the market, so I'm going to do that, and talk somewhat less about our funds. Saffron has been around since 2011. We've got more than 12 years worth of top decile performance. We recently won the Raging Bull Award for our active bond fund. We're systematic, structured, focused investors, and I think that is mainly because of the fact that we come from a hedge fund background and we apply the same technology to our long-only funds. We like to think of ourselves as a toolbox of skills. We've got a diverse set of skills within the business that can focus on any kind of market environment. And I think today what I'm going to emphasize is the fact that the market environment is changing significantly, both the structure and the amplitude of it. We've got an innovative and adaptable culture, and we focus significantly on technological progression. So I think what we're looking for is to try and extract more value out of our team by applying as much technology as possible to them. So to be able to run larger assets with smaller teams gives us a degree of business efficiency that allows a smaller asset management company such as ourselves to exist. Importantly, because of our size, we're exceptionally agile. We're able to move in and out of asset classes with very little movement or impact on the price. And as a result of that, we're able to take advantage of opportunities both quickly and efficiently. Okay, so I'm here today to talk predominantly about the Opportunity Income Fund. It has a Steffi +2 benchmark. It's managed by myself and Anina. Both of us have been managing the fund for in excess of 10 years. It has particular applications, for fund of funds and institutional funds, and delivers an enhanced level of real income, and we'll go through exactly how we do that. It's available on all the platforms, Glacier, Ames, Momentum, etc. So there's really no excuse not to invest in the fund. Okay, our gross running yield right now is sitting at just north of 7%. Our spread over JIBAR is sitting at 2.9%. Our modified duration, and of course it changes almost every day because of the volatility of the markets, is sitting at 0.6 years, but right now it's actually at 0.5 years. So a very, very low duration fund. Our credit duration is almost at 0.2. So again, very low impact from credit. Our weighted average term, so that's the weighted average maturity of all of our assets, is about 1.8 years. So again, very short. And our weighted average credit rating is AA-. Once again, playing at the better quality end of the credit curve. In terms of performance, you can see there our active bond fund made 9% last year. So that's our active duration fund. We have an income core and we overlay active duration bets, and that made just on 9%, and opportunity income made in the 7s. If we look at the longer term performance, and this is where I think it's super important because right now the cycle is changing. We're going into a rate hiking cycle. We're going into potential quantitative tightening. And it means then that you need an investment manager that can manage your assets through these cycles because these cycles will introduce more volatility. And you can see there, wish I had a pointer, you can see there that our annualized return over 5 years for our active bond fund is 9.2 and 8.9%, a very healthy 8.9% over 5 years. If we're looking at the 10-year performance, opportunity income comes through with a steady 8.2%. What's important about that particular chart is the fact that it is navigated successfully through multiple business cycles. And hopefully that's what it demonstrates. In terms of delivering a real return, the important, 90-odd% of the time we beat inflation. And almost 50% of the time we beat inflation +4. And that's a very interesting statistic with regard to an income fund. So we effectively are delivering almost equity-like or certainly absolute return-like returns for a significantly lower risk profile. In terms of asset allocation, we sit right now in almost 60% floating rate notes. The fund is aggressively positioned for rate hikes. We believe that we should be able to enhance that yield that I mentioned earlier by between 1.5% and 2%, purely from the point of view that the repo rate is going to rise. We also have taken advantage of significant offshore opportunities. You can see there from 2018 onwards, we've been ramping up our offshore opportunity or our offshore asset allocation because of the fact that we've been able to harvest far greater, far better risk-adjusted returns from our offshore positions than we have from our onshore positions. Okay, and this is where it starts to get a little bit more interesting, and I do wish I had a pointer here. In terms of the current market, where are we? We think that developed market rates have been bounded by central bank policy rates assisted previously by previously low inflation. Risky asset prices, in particular emerging markets and equities, have been supported by developed market bank balance sheets. And we can't emphasize that enough, and the impact it's going to have going forward as it unwinds. Previous attempts at rate and balance sheet normalization have resulted in significant volatility. Higher inflation and policy rates are likely to be the order of the day. As we get that developed market policy rate normalization, we've got higher energy prices and extended logistical and supply disruptions, all contributing to inflation. And of course, from a longer-term perspective, we've got concepts like deglobalization and, of course, the ever-present geopolitical risks. Now, this is an interesting slide, and what it shows is the accumulation of assets by developed market central banks. And the short answer to all of this is that they have a ton of assets that need to be unwound in a relatively short period of time. We've seen the Federal Reserve looking at starting to raise rates from March, and soon after that to start deaccumulating the assets, which means a reduction in global liquidity. Now, this for us is a very, very important theme, and we are positioned for it. If we look at global fixed income asset prices, what this chart demonstrates, just very briefly, and you can go through this in your own time, is that asset prices in the fixed income space are exceptionally expensive. Asset-backed securities, you can look at the spread there. The top black square represents their maximum, and of course, the gray represents their minimum. The red dot is where they are right now, and you can see that spreads across the globe are exceptionally tight. Given the fact that this has been on the back of massive asset accumulation on the part of central banks, it's fair to expect that these yields are going to rise significantly. Okay, if we're thinking about the all bond index and the different components of it, the 2-year point, the 10-year point, and the 30-year point, courtesy of Nedbank, they did a factor analysis. You can see that in particular in the long end, the black bar prevails, and the black bar is, of course, the impact of US rates on South African rates. So as the US rates lift, we can expect an almost disproportionate impact on South African rates. That's just a demonstration of that. Okay, this is a slide I found particularly interesting, and the one to focus on is the green line. The green line is, I need my glasses. The green line is emerging market bonds divided by developed market bonds. So what it does is it demonstrates the outperformance of emerging markets over developed markets. And what you can see there is that the green line has emerging market bonds have way outperformed developed market bonds. And that has been on the back of, 5 minutes, okay. That has been on the back of an exceptional demand for yield-producing assets. In particular, by developed markets. And what you can see is the red line is, of course, the relative performance of emerging market equities versus developed market equities. And you can see that emerging market equities have completely underperformed. And we think that they are likely to underperform for a little bit longer, after which you will definitely want to be long emerging market equities. And thinking of the green line there, what it means is that we have to be exceptionally careful about long duration in the context of global asset allocation and the shrinkage of central bank balance sheets. I think I'm going to run out of time, so I'm going to jump ahead somewhat. We really had a lot to talk about. Okay, here's an interesting one, and again, courtesy of Nedbank. What you can see there on the left-hand side is the dollar oil price per barrel, and on the left-hand and on the vertical axis is the dollar rand. And what you can see there is that the value of the rand, the level of the rand, is highly dependent on commodity prices, in particular here, the oil price. And the sweet spot for dollar rand is in the region of about $60 to $70. After which, when oil levels grow excessively because of its impact on global growth and emerging market currencies, the rand is likely to depreciate quite significantly. So we're not making a prediction. We're just saying that historically, very high oil prices place pressure on our rand and pressure on South African inflation and pressure on South African bonds. We have to be exceptionally careful of that. If we're looking at the oil price versus the oil bond total return, you can see there that, again, there's a sweet spot of between $40 and $50. Why is that? Because of its impact on inflation. Low oil, low inflation, lower yields. Right now, we're sitting at north of 90. Again, we have to be very careful. The numbers support a cautious view going forward. Okay, so in order to wrap up really quickly, I'm going to just explain why our fund is ideal for circumstances such as this. A wide investment universe allows us to capture divergent asset performance. An active investment management strategy is used to enhance yields and in particular to reduce risks, and I think our track record bears that out. Our fund is structurally, our asset allocation is structurally short, particularly in floating rate notes, to take advantage of higher inflation and a lifting in the short end of the yield curve. And most importantly, is that our allocation between onshore and offshore is highly dynamic. So we're able to take advantage of offshore opportunities. I completely agree with Bronwyn on that there will be fantastic opportunities going forward, and our active hedging will ensure that the volatility of those offshore assets isn't translated into the volatility of the fund. So we believe both the Opportunity Income Fund is ideal for these market circumstances, as well as our active bond fund, if you're looking for a higher duration, higher yield bet. And that's us. Thank you.
Good morning. I'm going to talk to you about the BCI Income Plus Fund. Today, well, last year was a particularly boring year, which is a good thing when you're managing credit funds, and BCI Income Plus is a credit fund. There were practically no defaults last year, which has the effect of compressing credit spreads. But this is offset by the fact that there were no credit losses taken in the fund, so it still managed to generate a good return for 2021. I've got limited time, so I'm going to give you the information that I think is pertinent to you, but I'm happy to take questions afterwards. So we'll have a quick look at the performance of global credit markets, look at the performance of the fund, and then what we can reasonably expect the fund to produce over the next sort of year or so. Now, this is a European high-yield credit index. It's the iTraxx Crossover Index. It's comprised of the 75 most liquid sub-investment grade bonds, all equally weighted. And you can see that, for the last sort of 8 years, barring the spike in spreads, this is spreads over Euribor. Barring the spike, at the onset of COVID-19 in 2020, spreads have been quite well contained between the sort of 200 and 400 basis points over Euribor. If we have a look at it, in a sort of more granular look at it, this is going back to the beginning of 2020, you can see that it's become more volatile towards the end of last year, from the end of the third quarter last year. This mainly due to the fact that fears of more aggressive tightening of policy rates by central banks in the face of increased upside surprises in inflation, and what that may do to credit markets. And indeed, that widening in spreads that you see from the end of 2021 is what has caused the underperformance in this fund in January. But again, this is not a one-day game. We have a look at issuer defaults that triggered credit default swaps. You can see that last year it was practically non-existent. There was one default that came through in December of last year. It was a Chinese company based in Hong Kong. Wasn't in any of the indices, so there were no credit losses related to that at all. And if we have a look, you'd have to go all the way back to 2007 to find a year that was more benign than last year in terms of defaults. After last year we had 23 credit events, was quite marked. If we look at it in terms of monthly numbers, going back to before the onset of the first wave of COVID-19, you can see that the credit events all clustered around the second and third quarter of 2020, and then fell off quite sharply, and then nothing at all last year except for this lonely little default that happened on the 9th of December last year. So it's been a rather benign environment from that point of view. We look at the performance of credit. This again is the iTraxx crossover index, but this time it's a total return index. You can see that last year it had a pretty good year. It added about 3.85%. Now, our offshore component, we hedge back to rands, so we essentially get that on top of the JIBAR. So that's 385 bips on top of the JIBAR from our offshore component. What you can also see here is the volatility of this index. Again, from the third quarter of last year, it's whipped around a bit because of this, fears of inflation and central bank policy rates. And you can see the underperformance of this in January. So this lost about just over 2%, 2.05% in January. We've got roughly about 24% in hard currency assets, obviously hedged back to rands. So you can see the effect that it has on a fund. That's about 50 basis points that the widening in spreads would have cost us in January. Just looking at the performance of the fund, it's got quite a long-term performance now. This is going back to 1 April 2014. So 100 Rand invested in this fund on the 1st of April 2014 would have given you 194 Rand and 92 cents to the end of January. If you've been in the top 40, 199 Rand and 96 cents, and Albee 188 Rand and 14 cents, and Steffi at 162 odd. So it's given you 8.89% per annum over the last sort of nearly 8 years. You can also see the effect of the COVID pandemic in March and April of 2020. We had a drawdown of about 2.7%. With the increase in credit events and defaults, and then quite a nice recovery since then. And then you can see the January number where it just dips off a little bit. What's also interesting to note, if you look at the base or Steffi, that's flattened out, obviously due to the cuts in the repo rate. That should start to trend up steeper now with the anticipated hikes in policy rates. So it's given you steady performance over a number of years now. If we look at the volatility of this fund, it's given you 8.89% per annum, standard deviation of only 1.59%. So we targeted annualized standard deviation of monthly returns of below 3% in this fund. So we've easily accomplished that. It gives you a very high Sharpe ratio because of the low volatility. And clearly, you would have been better off over this time period, in any case, being in this fund than being in an Albee tracker, because it's given you 49 basis points per annum over Albee after all fees, with about a fifth of the volatility. Now, admittedly, the volatility of local credit is a bit understated. Offshore credit vol runs more or less the same as sort of Albee vol. around 8.2, 8.4%. Local credit's a lot less volatile. This is calendar year performance since inception, going back to 2015. So 2021, 7.29%, 7.23%, need my glasses. So good performance last year. In 2020, we didn't achieve our benchmark, which is STEFI plus 2%. We only generated just over 1%, 1.07%. But we came back quite nicely last year and made up for it with 3.29 or 329 basis points over STEFI. If you average these out, we've given you, remember, benchmark is STEFI plus 2, we've given you 2.49% over STEFI over the time period. And then January, as I said, was a bit of a difficult month for us. This is purely down to the widening of European credit spreads, minus 21 basis points for January. So what do we expect from the fund going forward? Look, there are no guarantees about what the future is going to hold, and unfortunately, we don't have a crystal ball, but we can make some kind of assumptions. We know what the spread on the fund is, and we can look at what market inputs are for the base or STEFI, and we can get some idea of what would be reasonable to expect from the fund. We have a look. This is a one-year swap rate, currently sitting at 4.92%. It clearly showing you that the market is expecting policy rates to increase over the next year. Now, this one-year swap rate is derived from the individual market expectations of JIBAR going forward over the next year. If we look at those, these are the individual forward rates or market's expectations of where 3 months JIBAR will be going forward over the next year. These are from forward rate agreements. JIBAR currently 4.158. The market expects JIBAR in 3 months' time, the 3-month rate starting in 3 months' time to be 4.6%, JIBAR starting in 6 months' time to be 5.28%, and in 9 months' time to be 5.68%. So it's showing you that the market expects that policy rates will have to be, the repo rate will have to be raised by 150 basis points over the next 9 to 12 months, or that it will be raised by 150 basis points or 1.5%. So defaults, as I said, been quite a benign environment. There may be some uptick in those. Current spread on the fund is 285 basis points, or 2.85% over 3-month JIBAR. One-year swap rate is 4.92%. That gives us sort of 7.77%. If we factor in a little bit for credit losses into those numbers, wouldn't be unreasonable to expect the fund to deliver in the region of 7 to sort of 7.7% over the next year. If inflation accelerates more than is expected, and the central bank or the Monetary Policy Committee is forced to raise rates sooner and further than is currently discounted by the market, the performance of the fund will be better. Remember that this fund has got no modified duration exposure or interest rate exposure in it, so it's not exposed to the movement in bond yields. The instruments in this fund are floating rate notes. Their coupons are reset every quarter against 3 months JIBAR. So as rates move up, so the coupons on these instruments increase. So we don't take any capital losses from rising bond yields or anything like that. And obviously, conversely, if market expectations for rate increases over the next year prove to be a little bit too aggressive, then the fund will perform, slightly less than those sort of expectations. And that's pretty much it. Thank you.
Right, I didn't see any questions in the question room. So Bronwyn, Brandon, Louis, thank you very much for participating today. Really appreciate you being here. And just know that the audience back there is quite big. They're also looking. Maybe just I want to invite up, before I make closing comments on our fixed income managers, our next session will be on local equity. Ido and Johan, if you want to make it to the front so long. to present. Maybe just some comments quickly on Granite and Saffron. They'll be joining the BCI team on the 25th of March. I still think we're on for the date, so looking forward to have you as part of a family. And Brandon, you made the comment that you've got a lot to talk about. You're 100% right, but we'll get you to all our audience members as well, so we can cover all that information. I think all three managers are significant managers. Peer credit fund, I think there's very few or hardly any peer credit funds in SA. You really need it in client portfolios, so BCI Income Plus definitely is something that you should carry for your clients. On Granite, I think you're looking at fantastic risk-adjusted returns, always added in portfolios. So if your clients are sensitive to risk, but still looking for decent returns, definitely there. And Saffron obviously covering all angles in the fixed income environment, not looking at anything specific, but looking where there are opportunities for your clients and actively managing client portfolios on a very agile basis. Ladies and gentlemen, thank you very much for your time. Really appreciate it. Right, as I mentioned just now, our next session, local equity. I think it's probably going to be a lot of questions coming out of this session. Joining me now from Methodical is Ido, and from KDS Johan. So, gents, thank you very much for joining us today. Not to waste any more time, I think, Ido, if you want to start, you're more than welcome. We can get the session going. Thank you so much.
With regards to the loads of questions coming, please be sure to make sure they're quite easy. Otherwise, we'll pass them on to Johan. Thanks for your time. It's great to be here. It's great to be at a live event again. Welcome to everyone, especially my colleagues in Cape Town, hopefully rooting me on via Zoom. As you guys are aware, in the SA landscape or the investment industry, allocators or investors tend to, or perhaps need to, excuse me, they need to label or define or box fund managers and their styles. Now, the reason being is they obviously need to understand what to expect from a strategy, so that when there's underperformance, not if, when there's underperformance, they need to understand if it's the fund manager perhaps losing its touch, or is it perhaps the underlying style that's under pressure. Now, I think the SA landscape has been dominated over the past few decades via kind of traditional valuation styles. This has kind of morphed into today what is known deep value, but also into normal kind of standard value. I've also seen pragmatic value, growth at a reasonable price, etc. And also kind of general factors, whether it's growth, dividend, free cash flow, etc. So if you need to label Methodical, if you haven't done so yet, we firmly sit in the box of momentum investing. So that's momentum investing, the factor, not the company. It's not a joke. We have been asked before if we actually invest in the company. It's the factor, trend following. So why are we disciples of trend following or believers in momentum investing? So in the 19th century, a mathematician by the name of Francis Galton discovered something fascinating, which is today known as the wisdom of crowds. Now, on this particular day, roughly 800 people bought a ticket at a county fair. The ticket gave them the opportunity to guess the weight of an actual ox. Now, the person with the closest guess winning the ox. So Galton, the kind of mathematician that he is, or was, collected all the tickets, ran his calculations, and realized that the average of all the guesses combined was actually closer to the actual weight of an ox compared to the closest guess. So yes, this might have been a coincidence. Maybe everyone there was actually, cattle specialists or farmers, whatever. But this experiment has been done quite a few times in the next century, and more famously by a professor with the name of Michael Mabusson from Yale University in the 1980s. And in this instance, he placed a jar filled with jelly beans in his lecture hall. As you can see on the slide, the kind of guesses from his students varied wildly from 250 to 4,000. But lo and behold, the philosophy or the experiment that was done 100 years ago still held true. The crowd had a better guess than the individual. So our team at Methodical was actually part of such an experiment a few years ago. Morningstar, the data provider, and DFM held an event actually at Century City where we had to guess the pregnancy period for an African elephant. Now, the scene is similar to this one. More people, no COVID back then, but we're not veterinarians or professional hunters that would actually know how long is the pregnancy period for an African elephant. But the same principle held true again. The crowd, in this instance, again, was smarter than the individual guess. So it's our belief, or I guess thesis, that this is actually applicable to share prices. This is applicable to the market. Because at the end of the day, wherever the market or the Aussie closed today, or share price closed today, that is a function of the market participants in this room, globally, locally, and the decisions that they make on a daily basis, whether or not they are a buyer or a seller at a certain price. That's it. And it's this collective wisdom over time, these decisions by the crowd, that actually is the market. And that market, as you guys know, outperforms 8 out of 10 active managers over time. So the data shows the crowd is smarter than the individual. So how does trend following relate to this? So trend following is the kind of continuous study or analysis of share price movements. Because the share price movement is a reflection of your wisdom, you guys, the crowd, the market. So this is the biggest momentum index in the world. We call this a momentum index. It's a market cap weighted index. Our view is that any market cap weighted index is actually a momentum index because barring a large IPO, you actually cannot get into that index as a company, and you cannot stay in that index as a company if you don't increase your share price or your market cap relative to your peers. So this line is basically a line of winning companies, because if you decrease your market cap more than your peers, you fall out of this index. Obviously a massive index, $40 trillion in size. The crowd investing in this index is global, so it's billions of people, because this is the S&P 500. And this index outperforms 80% of active managers. So the red line is the interesting one. This is not a back-tested number that we've put on here to show you can actually outperform over time if you use the strategy. This is the MSCI US Momentum Index. It's tradable, investable. You can invest in your clients' money in this fund, iShares, BlackRock today. We've shown this to quite a few investors in South Africa, and the guys have always said, yeah, but there's more volatility in momentum investing. Perhaps there's larger drawdowns. If you actually look at the data, yes, the overall standard deviation is higher for momentum, for the index momentum versus the S&P. But the downside volatility is actually lower. So if you have lower downside vol, higher total overall volatility, that means you actually have massive upside volatility. That's a good thing, because it basically means that you're generating higher returns than your mean. So low downside vol, good. High upside vol, excellent. This is not just a US-based phenomena. This is the MSCI World. Same story holds true. Momentum outperforms over time. This isn't kind of pinpointed to give you guys the biggest effect of outperformance. You can run these numbers on a 5-year rolling. Consistently, momentum outperforms your standard index, because your standard index is already a momentum index, and now I've just enhanced that a level further. With regard to the comments on the drawdowns, in my view, it's kind of much of a muchness. 48% versus 46 in the tech crash, the GFC, 51 versus 54. I think when it gets to those kind of numbers, what does 2% difference make? I think everyone thinks that it's the end of the world anyway. So how do we use this at Methodical Equity? Myself and my co-portfolio manager, Shoal, who's actually in the audience as well, we don't see ourselves as portfolio managers. We actually see ourselves as risk managers, because we don't read financial statements. We don't meet management teams. We don't make forecasts on inflation or interest rates. We literally just study price momentum and focus on how can we manage the risk of the momentum factor, because each factor or style does have its challenges. So the biggest one for momentum is actually trend reversal or mean reversion or trendless markets. So we follow a rules-based approach. It's quantitative or systematic. It's not smart beta. We can get into that in the details if there's any questions. It's unemotional and it's repeatable. So our biggest thing about risk and momentum is actually, as I mentioned, mean reversion. So how do we counter that? The key thing for us is to actually cap our shares at 4% holding in the portfolio. So irrespective of the weight of the share in the index, we will always be underweight Naspers. The second thing is, if you cap your shares at 4%, you kind of open up the portfolio more to actually start buying the theme as opposed to buying the share. And that's important for us because you actually decrease your share-specific risk. And secondly, by buying the theme, you kind of increase the odds of doing well, because if the tide comes in, it lifts all boats, obviously. But what I mean with that is that, let's say, for example, gold doubles in price. All your gold companies will do well. If you're the smartest fundamental guy in the country and you pinpointed it's going to be GFI or Harmonies that's going to do the best, well done to you. But we'd rather actually just manage the risk and buy all the gold companies. And the same holds true for any kind of underlying derivative, whether that's platinum, whether that's interest rates for banks, whatever the case is. We go and buy all the banks if banks are doing well. We buy all the PGMs if they are doing well. And I don't want to give away the secret sauce here, but one of the biggest benefits for momentum investing is actually it mathematically prevents you from investing in a value trap. And that's massively important because in value traps is where you find your permanent loss of capital. So we wait for the trend to turn. You guys have seen the slide on the right-hand side. Normally shows you a line of intrinsic value. There's a margin of safety, so the company will buy it, or the investor, it might go down further. But we wait for the shares to turn. So once it does, we start allocating a little bit in the portfolio. If the signals are confirmed, we allocate a little bit more. If the share starts doing too well in the longer term, we actually start allocating away from that share. Because your rate of change of share price movement is actually quite important. If the rate of change is too quick in the short term, you have higher probability of mean reversion. So we take some of the allocation away so that the potential kind of negative attribution of the share in the portfolio is actually minimized. So value traps, and I appreciate this is potentially a sensitive slide, but if you look at what a value trap does and where destruction of value takes place, and let's use Steinhoff as an example. December 2017, bolt out of the blue, as it was called, Steinhoff did a minus 80 in a few days. But look at Steinhoff's share price the year before that. 2016 December, Steinhoff was touching close to 100 Rand a share. Before it fell off a cliff, it was trading at 55 Rand a share. So it was down roughly 45%. But it was down 45% in a market that was up 20. So that should tell you something. And you can actually look at all the shares on the screen here. We can go through any example you guys want, whether it's Enron, Tyco, WorldCom, Tonguard, EOH. Look at, by the time the share price falls off a cliff, look at what they've done before that. And that's what momentum investing does. It forces you to buy into the shares that are doing better, because at the end of the day, the market or the insiders know where there's trouble in a company. So what myself and my colleague do, we don't actually try and second guess what the market is saying, because the wisdom in the crowd, the wisdom in the market, shows that you need to listen to the market. So it's a different process, it's a different approach, it's a different outcome. Does it kind of hit the rubber, does the rubber hit the road with regards to how do we actually look compared to our peers? So this is fund correlations with methodical equity versus the biggest funds out there, but with offshore exposure. So we didn't include the ones that's domestic only. That is obviously included in line number 7 with regards to the equity general. So across the patch, we've got the lowest correlation. And that kind of has to be because we're not big NASPERS buyers, and we've got 0 to do with valuation in our process. Our highest number across the patch is 0.86. That's the lowest number of the biggest guys out there to us. With regards to equity peer group, we're obviously the lowest, and with regards to the all-share total return, we're also the lowest. So there's diversification benefits. The fund does have low vol, and with low correlation, if you add that to your current portfolios, in theory, you should decrease the standard volatility for your clients. But diversification benefits doesn't give you raging bulls, unfortunately. So it's about performance in the end. No matter what investors say, it's the long term. Everyone cares about performance. So we think our fund has done quite well. It will underperform again in the future. That's a fact. And I guess I need to just tell everyone it will underperform again in the future. But these are the rolling 3-year numbers. The fund started in June 2016. So our first 3-year number was in June 2019. So these are the rolling 3-year numbers compared to the equity peer group average. So since inception, we've basically never been under, on a 3-year rolling basis, the peer group. But as I've mentioned, there is underperformance, and it's always waiting around the corner. As soon as you think you're quite smart, the market will teach you a lesson. These are the longer term numbers. We had a challenging year, I guess, from a peer group point of view last year. The fund did a healthy absolute number of 25%, but we only beat 35% of the peer group. But irrespective of a tough, challenging year, relatively speaking, the long-term numbers are still there. So if you think you're an equity investor, but these 12-month numbers or 18-month numbers actually find quite challenging, if we only give you 25%, this fund is potentially not for you. What momentum does, which is key for people to understand, it moves into the style that's in play. So, we can't be boxed as a value now because we do look like a value fund now, or a growth fund, or a PGM fund in the future. But over time, if you stick to your process, you stick to the knitting with the momentum investing, your longer-term numbers do stack up. You cannot help but outperform the peer group because you use their skills against themselves. So just as a wrap-up, the crowd is smarter than the individual. We know that. But you can enhance your kind of skill set a little bit by being simplistic, using momentum to outperform and use the crowd skills against themselves. And that's my story. So the time is good.
Okay. Good morning, everyone. It's good to see some people in person for a change. It's been a while. So our strategy, the Katie's equity strategy, is a systematic multi-factor strategy. So we're going to pretty much build on what has just been discussed because we believe that combining value and momentum is the way to go. So as I've just mentioned, we focus on value and momentum, and as you can see, that split is a 60-40. So you guys are all astute, you're smart, you're wondering why isn't it 50-50? So within value, 20% of value basically contains overlap with momentum. So if you take 20% of 60%, it's about 12%. You are really looking at a 50-50 portfolio. Why value and momentum? There's so many factors out there. Why would you specifically want to take value and momentum? So as has already been elegantly proved in the prior presentation, thank you for setting me up for that. Value has a very low to negative correlation with momentum. And if you look historically, over 60 years in the US, the correlation is between -0.5 and -0.6. So you're getting a real risk reduction by combining the two. So what we're trying to do at Katie's is effectively we're trying to reduce risk. By risk, we mean volatility and maximum drawdown. That's really what this presentation is about, risk, not return. We want you to focus on risk. So the two PMs, it's Adrian Meager, he's a CIO and MD at Katie's. He's been in the industry for 26 years, and then myself, I've been in the industry for 8 years, and we've been managing this strategy together for about 4 years now. So what you will see is that we've quickly changed the name from Katie's Equity Strategy, and now all of a sudden it says Katie's BCI Equity Fund. So just for a bit of context, this strategy has been applied to another portfolio. It's a retail CIS. You can go look for it on Morningstar, and that's what we're going to be looking at performance-wise, risk metric-wise. The reason we're doing this is because that has a track record of about 4 years applying the strategy. Whereas the Katie's Equity Fund, unfortunately, has only followed that strategy for about a year now. So it was a huge transition, and looking at anything less than or a year or less is kind of pointless. We believe you should be looking 3, 5, 7 years out. So just quickly on this fund, FTSE JSE Cap Swix, that's a benchmark, fee of 85 bips, no performance fees. And just to explain how this is constructed, obviously, we're using the value factor. That's looking at pricing ratios. You guys are all familiar with PEs, price to sales, et cetera, et cetera. Then we look at liquidity and solvency. The reason we do this is to avoid value traps, effectively. So we are looking at the financials just to make sure everything's in place. The market cap above 5 billion, that ties in with the market liquidity check. We need to be able to enter into these positions and exit these positions without causing slippage, i.e. causing the price to move. We don't want to do that. So we kind of in the mid to large cap space there. This gets reviewed quarterly, and that's just really on the financial side, making sure the liquidity and solvency is still there, and then rebalanced annually. So we hold this for a whole year. When you look at the momentum factor, that looks at 12-month price momentum. We exclude the last month, so it's actually 11 months excluding the last month, and that's just to get rid of any noise from the last month, and that gets rebalanced quarterly. And then, of course, the 30% offshore equity, we're usually running that at between 25 and 30% at all times. So why follow this investment style? Like I say, it's all about risk. So we know about things like standard deviation, we know about maximum drawdown, but there are also things like behavioral bias. And I'd love to tell you, as a professional investor, I never suffer from emotional behavior when it comes to investing. Unfortunately, I am human, and sometimes we do get tricked by these biases. That's for everyone. So this strategy really does avoid this. And just to give you an example, during 2020, we all know what happened, specifically in March. Saw the bottom of the market on the 23rd of March. Come April, we follow our strategy, we rebalance our momentum, we review value, and we carry on about our business. That's all we do, systematically. So as I mentioned, we're going to reference the Katie's Equity Strategy, not the Katie's Equity Fund, because of the track record. And what you can actually see visually, if you look at the red line, that is just the standard deviation, the rolling 1-year standard deviation of the fund with the 1-month step. And you can compare that to the cap SWIX and the category average. The important thing to note is that it's really in these extreme risk events that this portfolio shows what it can do. You can see the vol is way less during specifically 2020 onwards. And then once again, just to show you with regards to maximum drawdown, the red, that's the strategy. You can see it is way less than the category average and the cap SWIX. So it's really protecting capital on the downside. Okay, so this is really the meat of the presentation. I know there's a lot happening, so we'll go through it step by step. This is a 4-year period. If you're looking at the red line, you'll see that's Katie's Equity Strategy. Over the 4-year period with the cap SWIX in green and the CISA category average in blue. We have the category average there not because we benchmark against it, but it is just for interest. Most people ask for it, so it's really just a reference point just to kind of showcase what we're busy doing. So I know I said this presentation is all about risk, but what would this presentation be if we didn't tell you that we at least beat our benchmark? The strategy did about 7.24% versus the cap SWIX of 5% annualized over that period. And once again, just as a reference point, the category average did about 6%. So as I said, the strategy is trying to beat its benchmark. Marginally, we're never going to be first. We're not aiming to be the best fund in the category. We're really just trying to beat that benchmark while reducing risk. So if you do look at the vol, annualized figure of 11.74%, and this is where value and momentum really adds value. That combination, just reducing that vol, and you can see that versus the cap SWIX of 16.87 and the category average of 15. The really interesting thing about this is, this fund, I'm going to be honest with you, it's a boring fund. It's not particularly exciting. We're not the smartest people in the world. We're not in reinventing the wheel. But what it does showcase is that during an extreme risk event, like we saw in March of 2020, we had a maximum drawdown of 24%. The cap SWIX fell 42%, and the category average fell about 35%. So that's not really the interesting part of the story. It's about how you recover from that. So let's say you start with a portfolio of 100 Rand, you lose 50% of your portfolio, you're sitting at 50 Rand. To get back to 100, you have to do 50 on 50. You have to do 100%. It's not the same as the way down as the way up. So if you can decrease your maximum drawdown, then the way to recover is less onerous, if I can put it that way. So where I say recovery return, that just means how you get back to the point of parity from before when you fell. And our recovery return was 32%. So even in a really extreme market event, we only had to do 32%. The CAPSWIX had to do 72% to recover. And the category average had to do about 54%. So what does that mean with regards to a time frame? It means that we were able to recover in 4 months, and the CAPSWIX managed to do it in 11. So the time frame of feeling that pain is also a lot less. And I don't know about you guys, I don't like seeing red. I don't want to be in the red. So as I mentioned, alpha over the period, 2.25% against the CAPSWIX. This translates into a Sharpe ratio of 0.11, which doesn't sound like anything extreme, but if you compare it to, for example, the CAPSWIX, it's minus 0.06. And if you compare it to the category average, it's 0.01. And just as a reference point, if you guys are wondering what risk-free rate I use for that Sharpe ratio calculation, I use the Steffi comp. That at about 5.93. And just out of interest, if you had invested in the CAPSWIX or a tracker over that period, cash would have beaten it by a whole percent. So to sum up, effectively, what we're trying to do is really focus on reducing risk while marginally outperforming our benchmark, which is what we have been able to do. We avoid behavioral biases, which we all succumb to from time to time. And we really believe that this fund is something that you use as a core or backbone strategy within a larger group of portfolios, and it complements other portfolios. So we reduce the risk, while other active managers who are more bottom-up, high conviction can partner with this fund to produce a good outcome. Thank you.
You know, Johan, that's been very, very insightful. So it's not your typical equity funds. You never know. A couple of questions that came in from the chat room as well. So we'll try to go through some of those questions. We have a little bit of time. But, you know, if I can maybe start with you, we've seen your numbers, and maybe just a point of view from our side, as we know there's very few momentum funds actually out there, or true momentum funds. They're few and far between. And I think because of that, to a lot of audience members or investors, you know, it's probably a little bit more unknown. We're so used to, you know, the value or the growth story, but we didn't talk about value just now. You know, so it is something very different, and if you look at a well-balanced portfolio, it is sensible to build in momentum because it does bring down overall volatility. We've seen the numbers. Longer-term numbers, very, very good. But maybe take us through the past 6 months or the past year. It's been a tough year, and not to talk about, in absolute terms, the numbers are there. I know people do compare versus peer groups, but maybe then rather take us, you know, how does momentum work? Is there a lag in the process, or what causes that lag with times? Right? Sound on the mic. Yeah, good.
Okay. I think it's an interesting question because, you know, every style's got a challenge, and it's normally where there's an inflection point where a style is challenged. So our biggest challenge as momentum investor actually took place in October 2020, where the first kind of word of vaccination came out. That was the biggest value unlock you've ever seen between value and growth.
Yeah.
So momentum does take time because you need your styles to come through, you need your sectors to come through, because we don't look at the short-term noise exactly like the way that my colleague does, or like Johan does. But the second thing is, and that's where my I guess core skill set comes in, is to try and find the ways where momentum does actually, where the shift is, and where they need to shift the portfolio to be more aggressive in the short term or the longer term. So momentum works at looking at from your 1 month numbers to longer term numbers, and you basically go and buy the best doing shares because the numbers show that the trend continues. Is that okay?
Yeah. Yeah, happy with that. And in terms of your universe that you play in, do you only look at large caps, or do you look at the whole of JSE? I mean, we all know this numbers of shares are declining, and to find decent stuff there is becoming more challenging. So what is that universe that you look in? And in that universe, you know, what is the frequency of them trading into these opportunities?
So we start off with looking at liquidity, which is the top 60 for us. We run the entire process at a certain weight at the top 60. Then we look at the top 100. So we want to make sure that if small caps are doing well, or not small caps, the kind of less liquid shares are doing well, we just don't cut them off. We don't look at the top 100 at once because we might not be able to trade into the smaller shares. So currently we rebalance the portfolio on a weekly basis. Things do change quite quickly. Ideally, depending on size, we want to rebalance the portfolio on a daily basis. That being said, as a caveat, the TIC is high. The TER of the fund is low, but the TIC is high because it's a trade-off for us. Do you want to be in the best share but pay up for it, or be stuck in the wrong share but bringing down the trading cost? And everything we've shown so far is net of fees. So the proof is in the pudding. Be in the best share as quickly as possible for us.
And how do you identify those shares? Is it price momentum, or do you also look at earnings per share?
I can't give away everything. I mean, it is price momentum. We don't look at any fundamentals whatsoever. You know, this process has been going on for 6 years now, and we've made 2 adjustments to it. It's an upgrade. It's not a new kind of operating system. We just upgrade the system. So it's price momentum only over different time periods, different sectors, different companies, different rules. And I think the next upgrade will probably take place in the next month or so.
All right. And I mean, going back to the TIC, if I look at other momentum funds, like I said, they're few and far between the industry. Because of the process, it does offer a little bit higher TIC, but it plays out over time, where you get the added returns over a 2 to 3 year period. Johan, next question for you. We've covered momentum style, and I mean, we've seen actually how you combine the styles. Value as a style, I mean, and Richard Pitt spoke a little bit of value, and he touched on, you know, quality this morning. And over the past 2 years, we've seen this roller coaster ride, but, you know, the switch between value and then growth, and then value and growth, and it's been a good unlock on value. But going forward over the next 12, 18 months, it is becoming a challenging environment with rates of inflation on the increase. You know, the value stocks in SA, just your views going forwards in terms of earnings and how you combine that in your strategy, the outlook in short.
So I know this is going to sound quite strange, but because we don't do any fundamental work with regards to our value components, I'm not really going to speak about earnings and things like that. But what I can tell you is that over longer periods of time, even though we've seen value really struggle versus growth, and there are, you know, a plethora of reasons for that, over long periods of time, as we saw earlier in these presentations, you know, the Berkshire Hathaways, you know, Warren Buffett, et cetera, value does come through over time. So, you know, at the moment there is obviously that rotation, and, you know, things are looking for, or are looking pretty good for value. But just on that note, you know, irrespective if value does well or poorly, we're still going to be in it to a certain degree. And the whole point is that momentum and value play against each other, and sometimes the one does well and sometimes the other does well.
But again, like the point you both make, lower vol type of strategies, and it could add value to clients' portfolios with lower correlations. Yeah. Gentlemen, thank you very much for your time. We do appreciate you coming through and joining our live session as well, and I'm sure for the audience time as well. Maybe just a short note to the audience, live and our virtual audience, we are going to share the slides and the presentations recordings afterwards. It should be up and running on the BCI website probably about 2 to 3 hours after the session end. We also had an interesting question, can we send the slides beforehand? We would love to do that, but very frequently there's a couple of last minute changes to the slides, especially with markets and stuff changing quite rapidly, or holdings or portfolios. But we took note of that. Gentlemen, thank you very much. Right. Our next session, and the last session for the day, multi-asset, high equity and low equity. And coming to the front, joining me on the stage is Roger Williams from Central Asset Management, we're very familiar with, and Bradley Anthony from Fairtree Capital. Yeah, you can. No, you need to go up. Sorry, Roger, in the spotlight. Roger, your slide pack is going to start first, so you can actually start right here. Yeah, you're first. Thank you very much.
Thank you. So let me just... Good afternoon, ladies and gentlemen. I'm going to present on the Centaur BCI Balance Fund. Just to kind of give an introduction to Centaur. Centaur is a retail-only asset manager, so we don't have institutional funds. At the end of January, we had $6.5 billion of assets under management, and last year we grew by 40% per annum. Centaur's been going for over 21 years. We're particularly proud of our long-term track record. So both of our unit trust funds are top quartile performers in their categories over all periods, 1 year and more. And last week we won a Raging Bull Award. I think what's particularly important, thank you. What's particularly important is really our founding principles. So when Centaur was founded over 21 years ago, really 3 core pillars to deliver investment excellence with outstanding service and utmost integrity. And that's really baked into our DNA. So all the staff and our team live it, and it's very important for us to deliver outperformance on an ongoing basis, because that's really our core product is outperformance, and that's how we add value to our clients. Just looking at the long-term track record, so this is 21.25 years, a net return of 19.5% per annum. So our first investors are up almost 45 times, outperforming the benchmark by 7.5%. So this really just shows you that we've delivered over a very long period, and I think it's very important that we perpetuate this performance in the future. Just our philosophy is relatively simple. We classify it as dynamic value creation, so we see a business as a value-creating, wealth-creating entity, which has to meet at least its cost of capital, and then we're also looking for undervalued situations. So simplistically, we are looking to buy undervalued growing companies. And just to show you conceptually how it works is the example on the left. If a company is creating wealth at 14% per annum, that's either by growing or delivering dividends, and we buy it at a 25% discount to fair value, and that re-rates over a 3-year period, your 14% growth is leveraged up to 25% growth. And these are the kind of situations we're looking to unlock. And what we do this is we've got an opportunity identification template. So we're scanning the world for opportunities which are recurring themes that fill our template, and then we drill deep into those opportunities, and if they meet our hurdles, we invest in them. This whole process is built into systematic modules, so we try to create the right balance between analyst fare and process. I think this is quite important because not one size fits all. I think what's particularly important, once we've analyzed something, we feed it into our stock picking engine, which we call TopSeg. This is virtually unchanged for 20 years. And what it does is ground us during times of volatility and saying these are expectations. And for example, during the COVID crash 2 years ago, it came to the fore where there were some exceptional opportunities during times of crisis and stress. We could make very quick decisions and pounce on these opportunities. And in the recovery phase, we recovered very quickly and had very strong performance coming out of the recovery phase. We've also got some macro models and risk models, so macro models to guide us on, say, the fair value of the rand, and also conditions in equity markets, whether we should be overweight or underweight. These are basically statistically tested and generally work over a long period of time. And we've also got risk models to guide risk management. I think the whole process is a holistic process, gives us control, particularly during times of uncertainty, and we know exactly what we're doing. So we can cherry pick the best opportunities. We've got a strong basis for our decisions, and this has come through in our performance. This process is not static. We evolve to changing market conditions. I think the market's completely different to it was 20 years ago. And if you don't evolve, you're not going to continue performing. Just to give you a stock that really meets all these criteria is offshore, is Dell Technologies. We see it as a high-quality company, founded by Michael Dell, probably one of the best businessmen of all time, from a dorm room business to the third, one of the top 3 largest PC suppliers in the world. And what we like, particularly as their strategy, is that they are broadening their base. So they're putting more products. They've got a very strong supply chain. So there's a lot of supply shortages. They've actually can supply the market, so they're gaining market share. And we see this is going to pay big dividends as corporates start standardizing on the Dell platform. So you can see on the right, the top graph, is their market share is continually increasing. We think this is an ongoing trend, really, because of their strategy of broadening their product base. But we also like the broader market. We see it growing probably between 2 to 3% real, but as they take market share, they can grow the top line probably at 5 to 7% real. What was surprising about this company, it's a very high quality, long-term growth track record, but we bought it on a P of under 8 times, and its return on invested capital has actually been going up. So you can see it's over 40%. So we're finding an undervalued, growing company, high quality, and we've got 4% in the balance fund. So that's just kind of showing you we're finding an opportunity which is both undervalued and growing, and we expect 20% plus returns in dollars from Dell. We bought it at about $50. That there was a corporate action as well. It's currently around $60. So in under 6 months, it's performing very well. Just some of our fundamental macro models to give you a taste. We have a purchasing power parity model on the rand, but how we look at equity returns, we look for conditions when they're favorable or not favorable. And what we've identified is during the interest rate cycle, when interest rates go up beyond a certain inflection point, the equity market doesn't perform. So we've got a tight phase when interest rates rise 1.5% off the bottom. We statistically tested this over 30 years. And during the tight phase, equities actually only deliver minus 1% return. During the loose phase, which we're currently in, equities have delivered 26% compound annual growth rate. And we can actually see this. You can see there's underlying demand for equities. So we classify conditions as positive, and we overweight equities. So that's how we employ this model in asset allocation. Just to give you a flavor, in the balance fund, we don't have enough track record because it's only been going 8 years. These models are strategic asset allocation models which work over a very long time. In the flexible fund, up to end of 2014, we were overweight equities. Then conditions were tight for an extended period of time. We're underweight equities. That's the green dotted line. And then in 2020, interest rates were radically reduced. That changed the paradigm. There's an inflection point, and we changed our equity content. Currently, we're about 85% equity content. So we've gone from about 65 to 70% equity content to 85% equity content to catch this outperformance of equities during this period. Just the asset allocation of the balance fund at this stage. Our benchmark is 64% equities. For tactical reasons, we did slightly reduce it over the last couple months, 1%. We're on benchmark. We're going to look to be at benchmark or above benchmark, but at certain times, there are tactical reasons it does deviate. In this case, there was a repurchase offer overseas, which reduced equity content. I think offshore equities seem to be playing out. So the US is going into a high interest rate cycle, which is not so positive, and we are remitting some funds back to South Africa. We think the rand is undervalued, so we do this by direct remittances or may use a currency overlay to reduce the offshore exposure. Bonds, we think, are good value in South Africa. We're marginally overweight and would look to increase bond exposure. We think 10% yields on the All Bond Index compared to 2% yields in the US, with inflation actually at similar levels. South Africa bonds are good value, and also the fundamentals seem to be improving for South Africa. Just some of our large equity holdings. I think what differentiates us, we've got some unusual stocks you may not see anywhere else. So Entain it's been a very good performer. It's one of the world's largest sports betting and online gaming businesses. It's listed in the UK. What's particularly exciting is it's got a very good track record and exceptional technology, possibly one of the best in the world. But they've moved into the US. The US sports betting market's just opening up on a state-by-state basis. They're the second largest. They've teamed up with MGM, doing exceptionally well. And we see as that gets critical mass, that's going to lead to value creation for Entain. We think on a sum of the parts basis, it's worth about £25. It's currently trading at about 16, but we see long-term growth from this company. Exor, also unusual. It's an Italian-listed holding company. It owns some well-known brands, particularly Ferrari. They're controlling shareholders, but they own 26% of it, amongst other companies. And this company is run by almost the Warren Buffett of Europe. His name's John Elkann. He's achieved over 20% compound growth rate in the net asset value over the last decade. But notwithstanding this, it's trading at a 43% discount to some of the parts. We think it's a good long-term holding at these levels. Aspen did very well last year. We like Stephen Sard. He's an exceptional entrepreneur, really a dynamic value creator. What he has done is reduce the debt considerably. He's invested in his manufacturing capacity. He's vertically integrated, and as this comes through, we see strong earnings growth, and we're looking for returns of over 15%. Dell, I've mentioned, we're looking for returns of 20% plus. And then Aspen's one, not Aspen, Absa we bought last year. We see positive management changes with the dislocation from Barclays, very undervalued, and a good prospect to outperform expectations. Just summing up, how has all this translated into performance? If you look over 3 years in the category, a very competitive category, there are 175 funds. We're number 6. Over 5 years, 13 out of 143, so top decile. And our target is at least 4% real returns. We're achieving that, and also consistently outperforming our benchmark. So meeting really our targets. I think our benchmark is a very competitive benchmark, but nonetheless, we have outperformed. And how can it benefit you for financial advisors? Putting the flexible fund, the balanced fund in the mix. What we have done is create 2 portfolios. So the one portfolio is the 4 largest balanced funds in South Africa, and that's the gray line, and that's achieved returns over the last 8 years of 7.7%. Then we've created an alternative portfolio, which is 5 funds, which is the 4 largest balanced funds and the Centaur BCI Balanced Fund. That's the brown line, and you can see that's outperformed by 0.7% per annum. So just adding a 20% holding to the Centaur Balanced Fund, you've managed to outperform with little added risk, and that's really adding value. We're adding incremental returns without added risk. Just summing up, that concludes my presentation. I think we're on top of our game. We've got a great team. We're very focused on performance. We've got a great track record. We're looking to perpetuate that in the future. I think we've got the tools, we've got the team, and we're very excited about the future. Thank you very much.
Morning, everybody. My name is Bradley Anthony from Fairtree Asset Management. I'm going to be talking about the Select BCI Cautious Fund. We partner with BCI, Select BCI, on a couple of different funds, and it's really a privilege to do so with a great partner. So we truly value the partnership. Thanks, Eugene. One of my major concerns this morning coming to this presentation was whether I was going to get my feet into my lace-up shoes and tie my suit pants after lockdown, but maybe I'm the only one. But yeah, it's a pleasure to see you all face to face. My presentation is going to start off with a choking hazard warning. And for those of you that remember back to 1999, I'm not talking about this kind of choking hazard. I'm also not talking about the choking hazard that awaits you after my presentation. I know I stand between you and lunch, so I'm going to try to do this very quickly and not bore you. I'm really talking about this choking hazard. There's a big debate amongst market participants around what is called the natural rate or the natural Fed funds rate. And you can look at this in real terms or in nominal terms, but the analysis basically goes as follows. If you look at the trend over the last couple of years, decades, the natural rate for the US Fed funds rate has fallen over time. And as that falls over time and the Fed responds to rising inflation, they're going to hike towards this natural rate. With all the concerns that we've seen around whether inflation is transitory or not, the question is, does the Fed hike past the natural Fed funds rate, or do they pause before that point? And it's an important debate because there are two camps as far as this is concerned. And the question is, are they going to hike beyond that choking point? Because once they hike beyond that choking point, the yield curve normally inverts, and that doesn't bode well for risk assets. Now, having said that, I don't know which camp I'm in, because I think that John Galbraith's quote is actually accurate. It's so hard to forecast markets. So I'm going to take you through a couple of slides just to give you a sense of what things look like out there. Why is it important to understand whether we're at this choking point, or going to get to this choking point? Because risk assets don't like tight monetary conditions, generally speaking. It's a broad-based statement, but generally risk assets are not comfortable with that type of environment. This chart shows you the S&P 500 in black, and then the Fed's balance sheet in orange. And whenever the Fed starts to taper or starts to reduce the size of its balance sheet, risk assets wobble a little bit. So, you've heard people talk about margin of safety. I'm neither a value or a momentum investor, but I'll just make some comments. We all like to think that there should be a margin of safety, and so that should tilt our portfolios towards assets which present some sort of margin of safety. So let's look, where is my margin of safety? We've seen charts earlier talking about EM underperforming DM in the equity space. If you look at it on a pure PE basis, EM looks reasonably priced relative to DM. So maybe there's a margin of safety in EM equities. What about South Africa? Just on a pure PE basis, All-Share Index doesn't look expensive by any stretch of the imagination. So surely that shouldn't be too bad. What about property? If you look across property, EM, global, developed markets, as well as South Africa, property yields are actually reasonably okay. Not bad. The big steal, the big opportunity has got to be South African bonds. I mean, look at those real yields. Roger was referring to it earlier. There appears to be a really good opportunity in South African bonds. These are real yields, so 10-year bond nominal yields minus inflation in those different economies, and you can see South Africa stands out as a brilliant opportunity. And how wrong can you be? This is my very simplistic fair value model on the South African 10-year bond rate. That's the kind of teal line. And then that's made up of a couple of different components. The US 10-year rate, the South African credit spread, as well as the implied inflation differential between South Africa and the US. So where that shaded areas, that's where the 10-year is actually trading. And where that little teal line is, that's where my fair value model says the 10-year yield should be. So lots of margin for error and safety over there if you go long South African bonds. If I was a betting man, I wanted to put something, I'd want to go with something, right? So do you put everything on red? Everybody reckons that Ferrari's probably got the best car for 2022, if there are any Formula One fans in the audience. I'm not sure. I quite like McLaren, but let's see where it goes. But if it was to put everything on red, where would it be? Which asset class would it be? Surely it's got to be SA equities. It's not too expensive. But from a growth perspective, South African growth actually looks quite docile and boring. You know, the UK is growing at a fair click at the moment, and they're a little mud island somewhere in the north with a bunch of really kind of older people. Europe's even looking better than South Africa at the moment. So from a growth perspective, I'm not so sure. And then even relative to our EM peers, what this chart shows you is kind of nominal growth, nominal GDP, pre the pandemic and then post the pandemic, and that green line is South Africa. And again, pretty flat and boring. So not hugely excited about South African equities. Maybe momentum, maybe value, I'm not sure. And then we also have our favorite problem child. You know, in 2021, we had the most number of load shedding hours and the most energy shed during a lockdown. It doesn't bode well. So even if this economy starts to really turn over at a click, can Eskom actually support it? So how much scope is there for growth in our economy? And then they're just listed on that slide as well are all the planned outages for this year, let alone the unplanned outages that we seem to stumble into every couple of weeks. What about South African bonds? Well, Louis earlier, my colleague showed what the derivative curve is pricing in terms of interest rate increases in South Africa. And my slide may be a little bit outdated. I think it's from about a week ago, so those numbers may have changed. But the bar chart on the right shows you where the repo rate is at the moment, and then where the FRA curve is pricing that repo rate will be. And the lighter shaded area shows you the implied increase in repo rates. Now, with the fragility in the South African economy, you know, are we going to be able to hike rates to the extent that the FRA curve is pricing? And why is this important? When you're in an inflation kind of targeting regime, which we loosely still are, no matter what the central bank tells us, as you hike short-term rates, the implication is the market believes that you're now building credibility to contain the long-term inflationary trajectory. So what happens is long bonds start to roll over. So the market's always forward-looking. We always hear this, markets are forward-looking. So these numbers are priced into long bond yields. So if the SARB actually decides to hike by less than what is implied, there's a very strong probability that our yields will actually start to rise relative to what's been priced in. So I don't know, maybe it's not in bonds, but at least we have property. You know, at least we know there's a sure bet on, maybe not. So this just shows you, if you want to bet on red, retail vacancies are in the red, and office trends reflects the trend globally that vacancies are on the rise. So property doesn't necessarily look like a sure bet. Funnily enough, we're starting to think that global property might look a bit interesting. You know, a lot of people think that as interest rates start to rise, property is not the place to be. But, you know, where there's sufficient demand and with reopening globally, with nice, robust economic growth, as inflation rises, your ability to increase rentals rise. So maybe there's an opportunity in global property. Who knows? But at least we have offshore. At least we know we can take our money offshore, right? This is just the PE on the S&P, and it looks quite expensive. What this chart shows you is it's lagged. So it shows you the PE in the yellow line, and then the 12-month performance subsequent to that point in the peak in the yellow line. And whenever that yellow line peaks, the subsequent performance in the S&P is pretty poor. So I don't know. Sounds very doom and gloom, but you know, when I look at this, the more confused I get about things. What are we meant to do? The one thing that I think is a good opportunity, contrary to all the headwinds that us active managers face, is there's an opportunity in dispersion. Now, what is dispersion? Dispersion basically looks at the cross-sectional volatility every day on a particular stock market. So this is the dispersion for the SA equity market. So it looks at the spread of performance in a given day, and then you take that and you move forward over time and develop this time series of performance among shares within a market, if that makes any sense. And when dispersion's low, it typically means that everything's trending together, and it's really hard to stock pick. And so, you know, think about the groundswell around passive investing in the early 2013s, 2014s, and it was justified because there was no opportunity set for stock picking. Then you have other environments where volatility is so high and dispersion is so high that you just get whipsawed. But over time, when dispersion is nicely in that range that I've highlighted there, it actually creates a pretty decent opportunity for skilled active managers who have proven security selection capabilities. So with that, let's talk about the cautious fund. So the way we view the cautious fund is that there are a couple of drivers of performance. We believe that strategic asset allocation will be the primary driver over time. And then security selection is really where we generate our outperformance relative to our benchmark. The middle bit, which is the sexy bit that everyone wants to talk about, which is being tactical and tilting away from headwinds and tilting towards tailwinds, is the difficult one to call. And I've just kind of almost spoken about and proven that. I sincerely hope that Ferrari has a good year this year, but McLaren could be in there, and people are even talking about Mercedes having a good car. So I don't know. I don't know which one is going to be the one that's actually going to provide the performance with a one-year forward view. So what we do is we stick to a very disciplined strategic asset allocation process. We've modeled this asset allocation based on the probability of meeting the return benchmark of this fund, which is CPI plus 3. So we want to hit the highest probability of hitting this over a rolling 3-year basis with the lowest possible volatility. All right, so that's how we've derived this asset allocation. Just a point to note that our global credit exposure, which is what Louis talked to earlier, is hedged back to Rand. And the reason why we do that is because the volatility of the currency vis-a-vis the volatility of these credit assets means that you actually end up taking a bet on the currency as opposed to the credit assets. As opposed to that, the global property exposure, which is sitting at 5% at the moment, is unhedged. So there is a bit of hard currency exposure. So this chart just shows my point earlier about security selection. What we've done is we've taken our asset allocation, our strategic asset allocation, and used market indices on the left-hand side to show you what the fund performance would have been like. And then we overlay on top of that our underlying particular strategies within Fairtree. So for the fixed income bit, we use Paul and Louis. For the equity bit, we use Stephen and Cor and the Fairtree equity team, and our global property team for the property bit. And their security selection essentially provides the outperformance that you see on the right-hand side. Over time, just to show you how poor we are at tactical asset allocation, you can see that we actually detract value when we try to be too clever. So what you're not going to get in this portfolio is us trying to be smart about tactically asset allocating. What we are doing is we are rebalancing on a monthly basis back to our SAA. So what that means for you as an investor, why is that important? To us, it makes intuitive sense. When something runs and you get an uplift in value, you're selling into strength and you're buying into weakness. So you're constantly getting this monthly rebalancing back to your SAA, selling into strength, buying into weakness. So that's the one thing you're going to get from us, plus the security selection. This is the performance of the fund over time, relative to the benchmark. The blue being the benchmark, and the yellow bits being the performance above the benchmark, or unfortunately, as in 2018, the performance below the benchmark. Believe it or not, we get it wrong often. And we've been managing this fund now for close on 5 years. We took over the fund in March 2017, and over that entire 5-year period, we've managed to maintain outperformance, a decent slug of outperformance over the benchmark. And in addition to that, we've maintained really good performance relative to our peer group. So going forward, we've looked at what we anticipate returns from the various asset classes are going to be, and we think that the SAA is going to provide us with a similar type of outperformance relative to our benchmark. I have no control over what our peers do. It's great to show us being number one over 5 years in this low equity category, but that's not what we're managing for. We're managing to beat the benchmark, and if we do that consistently, hopefully we kind of trickle to the top of the peer group as well. Thank you very much.
Now, very interesting. I think with both Fairtree and Centaur, if a client asks you, just send me your fund details, I just send performance numbers. I say it's in the numbers. Well, I will leave it there. There was one question from the chat room. I'll try to cover that question very quickly. Before I do, Roger, maybe just a very quick question from your side. On the balance mandate you spoke about, well, as a flexible mandate, very nimble, active asset allocation, stock selecting capabilities. You always talk about the central way, but maybe just explain to us very, very quickly, with the asset allocation process and that stock selection process, what is that central way in a very short sum? Sorry, Roger, just a mic.
The central way is really taking our process and putting it into a manual, so the staff are mentored in it and they understand it. But I think, what we found is it's a process, but we also encourage individual flair. So it's the right balance between process and individual flair. So we've got consistent quality and approach at Central.
The number shows that it actually works. Bradley, very quick question for you, and it will maybe address a question from the audience, virtual audience as well. If I look at your numbers, I mean, with all the mandates that you guys manage, and maybe just, you didn't mention you also manage to select balanced mandate as well, but only for the past 2.5 years. The cautious mandate you've been managing for quite some time. Personally think it's maybe an unknown mandate because of the name, but if you look at the numbers, definitely something clients should include. But maybe just take us through Jan, because if I look at all the other mandates, whether it's low equity or high equity, everybody took a very, very hard knock. Yet the cautious fund for the month of Jan is still up. Now, does that equate to your stock picking capabilities, or is it the sum of all components within the fund? Why did the fund do so well? And that could maybe explain, a bit of your process as well, what clients can expect.
Again, it's probably a bit of both. I think we certainly struggled in the income plus component of the fund because of global credit spreads blowing out. But we had a pretty decent equity month. But again, the way we think about constructing the portfolio is that we try as far as possible to not have one component of the portfolio dominate over another. Our global property allocation did reasonably well as well. So what we hope to achieve over the fullness of time is that these things balance each other out. There are always going to be short periods of time where that relationship between the different allocations actually don't play out as well. But fortunately for us, January, it played out reasonably well.
Good stuff. Roger, Bradley, thank you so much for joining us today live here in Cape Town. This is the last session of the day, and like I said, we are going to go break for lunch now. Are you going to join for lunch? If there's any questions from the audience, if you want to talk, you're more than welcome. Maybe just some closing remarks from my side. We've seen it through the presentation as well. Maybe just to start off, we always had this debate last year or the year before that, active versus passive. We've seen what markets look like at the moment. You've seen that, there's a bit of caution on just bluntly or blindly buying markets. You've got to be selective in terms of what you're buying, and I think, it's really time for active managers to shine more. So my bet is on active, most definitely. Lower probability of everything blowing out between Ukraine and Russia, not a zero probability, but maybe it should be okay. Bonds remain very attractive. SA equity, global equity, very attractive for 2022. So overall, I think we're in a sweet spot. It's going to be a bit of a bumpy ride. There's going to be a lot of news flow coming out, and we all know, on news flow, there's also somebody or something that happens, but it will wash out over time. And then just closing remarks, don't forget that next week, Wednesday, 16th Feb, and the weekend after, or the week thereafter, 23rd of Feb, we've got 2 more sessions, so make sure you're joining our sessions as well online, more than welcome. And then just last word of thanks to our sound and production team at the back. Guys did an awesome job. I know for the live audience, they don't always see everything that's happening, but the virtual side, everything running slick and smooth, and I know it's a big story to get all these things together, so thank you so much for that. And from Excel Academy, also driving the virtual side, Dan and Avi, we can't see you, but we know you're there, we know you're listening, thank you so much. And the BCI team for setting us up, especially Tanya and Olga for all your arrangements. Thank you so much, and Marguerite here in Cape Town as well. To our audience, live audience, thanks for attending, thanks for coming through, I hope you enjoyed it. That's it from our side, and please join us for lunch afterwards outside. For our virtual audience, if you want to drive through for lunch, best you hurry. Right. Thanks a lot.